New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today, starting with the markets.
That's right. Stock futures this morning looking for a comeback after the S&P 500 and the Dow closed Wednesday session lower. Wall Street tracking some fresh data out this morning, the third revision for second quarter GDP. We know you were sitting on the edge of your ergonomic chair for this one, coming in a hair stronger than expected, but in line with the previous estimate. Meanwhile, jobless claims came in lower than expected, showing some signs of resilience in the labor market.
And the rally in Nasdaq futures fueled by Micron's big earnings beat thanks to unrelenting demand for AI. The chipmaker forecasting higher than expected revenue for the upcoming quarter, and that paired with a stronger than expected report is enough to push many of its competitors to the upside.
That's right. And elsewhere abroad, China stocks closing out the day strong after a report revealed the country is weighing a $142 billion capital infusion into its biggest banks. Now, this move would mark China's first injection of capital into banks since the 2008 global financial crisis. The report extending gains in a rally that was sparked earlier this week over new measures aimed at boosting China's weak economy. Micron's strong outlook is sparking a global rally in chip stocks, the company delivering better than expected earnings and revenue guidance, driven by some robust demand for its AI-related memory products here. Take a look at shares here this morning. They are extending gains in extended hours here. They're up by about 17% as of right now. And of course, that adds on to much of what we've seen over the course of this year for Micron and ultimately kind of what the street was looking for, especially when it comes to, will they say the thing? Will they say the thing? Will they say that demand is remaining strong for them? And it's really coming back to how much of the demand they are continuing to have capacity for. I think that's something that they brought up within this earnings release and on the call. And that's something that we should be monitoring closely, especially for all of these major companies that have talked about how much demand there is. At a certain point, some of that demand is going to overflow and it has to kind of broaden out to some of the other names here.
Yeah, it seems like right now Micron almost has a supply issue rather than demand. You talk about that demand. They actually said that they've already sold out of their product for 2024 and 2025. So what does that tell you? It gives them a little bit more pricing power. Obviously, that's good news here for Micron, going to help their margins down the line. That was one of the driving factors for why they did give better than expected guidance. And when you take a look at the move, the degree of the move in Micron stock earlier or here this morning, if the gains do hold at the open, you're actually looking at the biggest jump right now that we have seen, if you look at the pre-market action, right now that we have seen in just about 6 months there. So again, the company already selling out of its product for the remainder of this year and looking ahead to next year. All of this excitement driving that nearly 18% move to the upside here in Micron shares. And then ultimately why this is such a big story this morning is we're seeing this rebound play out across the sector. Many of the names, many of the chip names that we had on your screen just a moment ago on track to open the day in the green. A lot to talk about what that upside looks like for this sector. When you take a look at the Philadelphia Semiconductor Index, still only regaining about half of the losses that it has seen since its July peak. So of course, one of the things that's being thrown around amongst analysts here this morning is that actually signals that this recovery has a much greater runway here, much room to run here to the upside. And to the degree of that, I think is something that investors are trying to figure out here this morning.
Yeah, record high revenues the company achieved in its NAND and its storage business. And then additionally here, thinking about the fiscal 2024 revenue, that grew over 60% here.
All right, econ data spelling out some good news for the economy. Stock futures higher after the latest GDP estimate showing that the economy grew a solid pace for the first half of 2024. We're really seeing that action play out in yields in the bond market here. But also we want to talk about the Labor Department because we got jobless claims out this morning showing less people actually filed for unemployment benefits. So what does all this signal here? What does this mean ahead of that jobs report that we're going to get next Friday? For more on that, we want to bring in our markets reporter, Josh Schaefer. And Josh, when you take a look at this, good news, bad news, what is your read?
No news is good news, right? That's something we talked about earlier this week in terms of what the market has priced at this point, right? We feel like you could definitely argue the market has priced a soft landing, meaning that data will continue to come in relatively consistent. So when you look at something like a third estimate for GDP, it came in at 3%. Same with the second estimate. That's a good thing, right? That's fine. That's fine. It was a quarter that ended at the end of June, we should note, but largely the story with GDP right now is we're tracking for about 3%, depending on who you ask, for this quarter as well. Atlanta Fed GDP now is at 2.9%. Goldman Sachs' economics team is at 3%. So you still have a solid story in terms of economic growth. And then I think perhaps the bigger takeaway here is from the weekly data set when you look at jobless claims. Jobless claims coming in at 218,000 people filing for weekly claims. That was lower than the 223 the street expected, and the lowest level since the middle of May. So to have jobless claims coming in that low, this is a story you're going to hear a lot over the next week as you guys speak to economists ahead of this jobs report. Yes, the labor market is cooling, but layoffs are not picking up. Layoffs are what we're watching. Layoffs are what we're concerned about. When people get laid off, what do? They file for unemployment benefits, right? So to see that continuing to not tick higher is a positive sign, and it's sort of narrative unchanged, which when eco data comes out at this point, I think narrative unchanged is a solid thing if you're an investor.
Yeah, that's a great point. I mean, for the number of people, and I think back to the conference board data that came out earlier this week, thinking about the present situation and consumers thinking about the labor market and how easy it is to get a job. 30.9% of consumers saying jobs were plentiful. That's actually down from August's read, and then 18.3% of consumers saying jobs were hard to get. So what is the true reality of the ease of getting jobs, even if we do see more openings than people who are out of work right now?
Brad, you fed into a story I'm working on that will be up on our website this
Ooh,
week.
that's what
so
we
go
like to
check
do.
It out this weekend.
Alley-oop style.
But one thing economists are sort of saying right now is there's been this phrase that people have coined over the last 6 months. We went from the great resignation to the great stay, which is essentially, okay, I'm not that comfortable to leave my job because I don't know if I can get another one. But my employer is not laying me off because they worked so hard to hire me during that hot labor market in 2021, right? It was really hard to hire people. So employers don't want to get rid of those people, and workers don't really want to leave anymore because, as you said, people that are finding jobs are hard to get is ticking up. So as long as people aren't getting laid off, like that claims number we just talked about, because right now you don't want to see people get laid off if they think a job's hard to get, right? It's going to take them a while, perhaps longer than normal, to find a job. So you're seeing just kind of this stasis where the labor market isn't necessarily hot like it used to be, but it's not cooling off at a level that's concerning. People largely still have jobs. They're still able to spend. So right now you're in, again, that little bit of an ideal scenario. I don't know, we're not supposed to use the word Goldilocks, but we can throw it out there. You're in that kind of ideal state, and it's how long can you stay there? At what point do maybe those Fed rate cuts help boost that labor market a little bit more?
All right, trying to thread a needle here. It's not as sexy as, just saying one word, Goldilocks. But, anyway.
People don't like that word, Brad. You gotta be careful with that one.
Yeah, exactly. Josh, thanks so much. Appreciate it. Well, the latest second quarter GDP growth estimate left unchanged today at 3%. That's a slightly faster clip of growth than economists were predicting, but our next guest sees U.S. growth gradually slowing in the months ahead. Joining us now with her fall 2024 investment outlook is Gargi Chowdhury, BlackRock America's chief investment and portfolio strategist. I tell you what, Gargi, there's nothing that gets me ready for a PSL like a fall outlook here, and you've delivered just that. Take us into the thesis and the base case for the U.S. economy, and then the investment strategy on the back of that.
Sure thing. Good morning. It's great to join you today, Brad. You talk about PSL. Let's also talk about leaves falling and rates falling. All of that a part of our fall outlook. Just this idea that obviously economic growth remains very strong, which bodes well for both investors that are looking for returns in the equity markets, as well as an amazing opportunity in the bond markets to clip coupon to earn income. That is
Gargi, we're having, apologies for cutting in here, we're having some audio issues. We're going to try and get that worked out, and we will get back to you as soon as we can. It doesn't sound like she can hear us as well. So again, we're going to talk about just some of the dynamics at play within the market right now. And Brad, when you take a look at some of the econ data out this morning, how investors are taking it, looks like they're looking as no news or no change really to the trajectory of the economy, to the trajectory of what we have been talking about, what has been forecasted by the Fed as good news here. I think the question going forward is how much of this upcoming data could potentially reshape that narrative and maybe the risk that then could potentially pose.
Yeah, and I'm looking forward to getting Gargi back, because one of the things within their macro outlook that they had really chimed in on since the update since that mid-year investment direction, it was that economic data, to your point, had remained resilient, but shows signs of slowing growth here. Wage growth, one of those areas that has been called out, and it was strong in August. 3-month average employment gain, they say, the weakest though since the pandemic, averaging about 116,000 jobs per month. I understand that we might have our good friend Gargi Chaudhary back. Gargi, can you hear us?
Yes, I can.
Wonderful. We can hear you too. We love that. Okay, so let's pick up where we left off. You were discussing exactly what the leaves falling, the rates falling, and then we kind of lost that audio after that point. But
okay,
what does the rate falling environment or new rate policy environment signal for some of the investment strategy that investors would be apt to proceed with?
Absolutely. So with the backdrop of the strong growth, especially the one we saw this morning, with growth still remaining at 3%, maybe slowing down a little bit in the last half of the year, but still remaining very robust and above potential, we have this dynamic where the Fed is stepping in, cutting rates, 50 basis point, obviously last week, but telling us that they will do more if required to prevent the economy from slowing down further. That backdrop is really great, especially for those investors looking to earn income in the fixed income market. So that is what we're highlighting in our fall outlook. Clip coupon in the belly of the curve, go into the income generating parts of the market, such as securitized assets, such as defensive high yield, such as parts of emerging market, because that is where you're going to earn the income. And this is a great time to step out of cash and earn that income.
Gargi, when you talk about the fact that your base case here is for the U.S. economy to slow, I guess to what degree then should investors, when they're trying to figure out the best opportunities within the market, should they be prepared for more volatility? I guess, does that then up the risk that we could see some sort of shocks down the line, and then ultimately that could obviously trickle through here to the markets?
Honestly, when I say slow, what I mean is that we got used to an environment of 4%, 3% growth. When we say slow, and we saw this from the Fed's own statement of economic projections, coming down to sort of a level of around 2%. Slow does not mean that we're talking about getting down to negative levels or anything that resembles a slowing down in recessionary terms. This just means more moderation, similar to what we've seen in the labor market, where obviously we're beginning to see job growth coming in the hundreds of thousands instead of the 200,000-300,000. I want investors to understand that this is normal. This isn't something that they should be worried about or scared of. They should continue to remain invested. Look at the higher quality parts of the equity markets. We love leaning into quality, qual, as a way of expressing that view, and then broadening out to value, especially to large cap value, where we think we're going to see a little bit of performance return, especially as we go in to these last 3 months.
Gargi, entertain my question here for a hot second. What are the characteristics of a quality company from your perspective and evaluation?
Absolutely. So the three things that we're looking at right now as it comes to quality companies and large cap companies that we like is, number one, having that very strong earnings growth, continuing to have consistent, strong earnings growth. Number two, having the ability to generate ample cash flow, which is really important, especially if we slow down just a little bit. Number three, being very cognizant of the debt, the leverage. So having low leverage is another thing that separates a higher to a lower quality company. And one of the things that we've talked a little bit about in our fall investment directions is this idea that small caps perhaps are not going to have that sustained performance. They can have periods of outperformance, but not the sustained performance. And large caps and quality is where we think we're going to see a little bit of a better performance into the remainder of the year.
Gargi, while we have you, between now and the remainder and the end of the year, we've got a big election event here, and it's been a massive year for elections around the world, but here in the U.S., it seems like there's not been a more polarizing time. So for investors that are trying to really figure out how businesses are navigating this and make sure that their portfolio perhaps has the best bipartisan policy in their own strategy, how do they effectively go about doing that, regardless of what the outcome looks like, making sure that they're positioned well?
Absolutely. And thank you for that question, because clients across the US are asking us about, what should we do? How should we invest going into the election? So a couple of things that we lay out here is, number one, keep politics out of your portfolio. So think about the areas of the market that will do regardless of what happens in November or January 2025. Thinking about infrastructure as a great way of playing that. We think infrastructure can continue to do well regardless of who's in power. Thinking about manufacturing as a way, especially US manufacturing. Thinking about the importance of independence of technology, tech independence, so important regardless of who's in the White House. If you are concerned about volatility going into the elections, which maybe some investors are, do not go back into cash. Think about ways in which you can protect your downside with things like buffered strategies, such as MaxJ, or things like minimum volatility strategies, such as USMV, that allow you to stay invested, but preserve your downside. So stay invested, step out of cash. We understand that you might be feeling some nervousness about the elections, but keep politics out of your portfolio with some bipartisan ways that we lay out.
Gargi, always great to have you. Thanks so much for hopping on with us here this morning and kicking things off.
Thank you.
Well, Hong Kong stocks are rallying. We're going to break down why this matters for you right after the break. And a programming note, are you on the hunt for the hottest market commentary? Watch Opening Bid with Yahoo Finance's executive editor, Brian Sozzi, for unrivaled insights from top analysts and direct lines to the biggest power brokers in business. Tune in every Monday, Wednesday, and Friday, 8:30 a.m. Eastern Time. Doesn't sound like you want to miss it. We'll be right back.
Welcome back to Morning Brief. Now it's time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Okay, let's go overseas. Hong Kong stocks rallying, pulling European markets higher. This after China reportedly weighs stimulus for the country's big banks, a part of its economic stimulus package unveiled earlier this week. To discuss why the moves are important for U.S. investors, we have Yahoo Finance's very own Akiko Fujita. Hey, Akiko.
Hey there, Brad. Yeah, the simple answer is China is the world's second largest economy. Certainly any implications from that country trickling over to the U.S. We did see Chinese stocks now on track for their best week in a decade on the back of that rally we saw overnight. The CSI 300 jumping more than 4% here. An index of mainland Chinese stocks, property stocks, I should say, also jumping in a big way. Those gains coming on the back of what amounted to an acknowledgement by Chinese leaders that, yes, in fact, additional fiscal spending would be needed to be deployed here in order to jumpstart the domestic economy. The Politburo saying specifically that China would deploy, in their words, the necessary spending to reach its stated growth target of 5%. The leadership pushing for additional cuts to interest rates, as well as a reserve requirement ratio for banks to ease lending conditions, calling on the forceful implementation of that policy. Now, the backdrop to all of this is the weakening growth that we have seen over in China and increasing concerns about China's ability to regain the kind of growth we've come to expect from the country over the last decade or so. Specifically, we saw the August data not necessarily leading to optimism here. Retail sales slowing to just 2.1% growth. Industrial production was up 4.5%, lower than expected, with industrial output falling to a 5-month low. And then, of course, you have the youth unemployment rate here nearing 20%. Steve Sosnick with Interactive Brokers reiterating that China's slowdown likely to extend to the U.S. given the size of the economy, saying that U.S. investors should be rooting for the Chinese to succeed because ultimately that's a big boost to global growth overall. Take a listen.
In the aftermath of the global financial crisis, one of the things that helped us dramatically was that the Chinese economy was expanding so rapidly, and as a result, it had spillover effects into the rest of the world. The flip side is if their economy shrinks dramatically, that will also have spillover effects into the rest of the world, just as it seems that things are slowing down.
Now, even with those comments coming through from Chinese leadership today, there's increasing temporary expectations when it comes to where the Chinese economy is likely to grow this year. Goldman Sachs and Citigroup both lowering their full-year projections for China's economic growth from 5%, which is the stated goal over in China, to 4.7% now, guys.
All right, Akiko, thanks so much for breaking that down for us. We want to turn to some news out of Meta. New product announcements boosting shares, unveiling including a new entry-level virtual headset. Wall Street so far seeming to like what it heard and what it saw yesterday, with a few bullish calls coming out this morning. Here to break it all down, Yahoo Finance's Yasmin Quorum is here. And Yasmin, when you take a look at what was announced yesterday, it does certainly seem like the street is encouraged by some of these AI initiatives.
Yeah, Wall Street is super optimistic on Meta this morning. The stock hit an all-time high yesterday. Bank of America hiking its price target to $630, up from $563, and reiterating its price rating. Jefferies calls Meta one of its top picks for AI in a fun note titled "Zuck Yeah" on a new AI future. JP Morgan, Citi, Morgan Stanley, and several others reiterating their buy rating on the stock. And it's all on the heels, you guys, of these really interesting announcements yesterday. They're adding celebrity voices to his chatbot Meta AI. Users can now chat with the voices of actors such as Judi Dench, John Cena, Kristen Bell. As you mentioned, Shauna, they unveiled the Quest 3S. There's updates to the Ray-Ban smart glasses. An interesting note from Roth today asks, are we at peak Reality Labs loss margins? So it may not all be roses yet for Zuckerberg and company. I have some exclusive reporting out today about Meta's big AR project, Orion. Yesterday, the company's head of AR walked onto stage with a briefcase handcuffed to his wrist. There's a reason these AR glasses are so under wraps and shrouded in secrecy. Former employees who worked on these glasses for the last couple years tell me that they're very inspiring, very cool, but we may never see the light of day and we may never be able to purchase them.
You know, I didn't have Mark Zuckerberg wearing an oversized T-shirt on my bingo card when I was going in and watching this event yesterday from MetaConnect, but there was a lot to really unpack with this. I mean, what we heard him saying and really trying to make the pitch for, and I'm interested in knowing what you're hearing from investors out there, is the reality of whether or not some of the VR glasses, things of that, in the wearable sense that Meta is thinking about them, can replace things like the iPhone even at this juncture.
Yeah, the company has poured tens of billions of dollars into his bet on AR and VR. He actually confirmed to The Verge yesterday that he spent around $5 billion on these Orion glasses. This is really his baby. He's betting big on it. People tell me that he really sees this as the future of blending reality with the digital world, and he eventually wants to see these AR glasses replace smartphones. So it remains to be seen what happens with some of these moonshot projects in Reality Labs, but for now, Wall Street is super into these AI announcements.
Well, it depends. What price? How much am I paying for these? Do we know? We don't know yet.
Right now, they're a lot.
Yeah. I mean, even so, I guess that's what I'm comping right now, Shauna. Is if I'm paying $3,500 for the Apple ones, which I'm not doing that yet, or if I'm getting these.
One day, Brad.
We'll decide. Price needs to come down a little bit. Yasmin, thanks so much. Yes, indeed. Thanks so much. Well, Southwest Airlines shares, they are rallying this morning. The airline raising its revenue per available seat mile guidance and announcing a $2.5 billion stock buyback program. The company is hosting its Investor Day today in Dallas, where they are expected to unveil the next phase of their 3-year turnaround plan. Take a look at the shares right now. This morning, you're seeing them up by about 5.9, nearly 6% here. Here's what you can probably expect to hear a little bit more around, especially considering what they've already needed to say following some investor pressure here. They're probably going to need to make some changes to the route network, revenue management techniques, marketing, merchandising, and distribution methods. All of these have come into focus as there was even more pressure from Elliott. And then significant new operational initiatives. It'll be interesting to see what kind of color and detail they provide around that. They also made some changes at the board level this morning too. And so that's going to be interesting to see how the street continues to price all of these announcements from Southwest in the day of its Investor Day.
It almost just sounds like a complete overhaul by the company. And I don't think it's necessarily a huge surprise given the pressure that, one, the stock has been under point blank, but then two, when you talk about the fact that Elliott has entered the conversation, the pressure that Elliott has been placing on the board, on executives, they needed to do something. So Bob Jordan, the CEO of Southwest, making it clear that he is trying to do everything he can to save his job, to get investors on board with some of the changes that were announced, because we know Elliott, and part of their changes that they are pushing for the ousting of CEO Bob Jordan. So again, we know that Gary Kelly is leaving the board. A number of other directors are also leaving the board here over the next year, are going to step down by the end of this year. But again, plans going forward, including a number of these changes, including recent announcements here to offer assigned seats. They're doing this all in an effort to try to steer the ship in the right direction and really turn around some of that momentum that has been weighing on the stock over the last several months. Whether or not it's going to be enough to do the trick, time will only tell. But again, when you take a look at the underperformance of Southwest, it's clear that shareholders have not been happy, but they are encouraged by this news with the stock up almost 6%.
Yeah, spot on. The only other thing I'll point out around this too, in some of the guidance that they updated as well here in the revenue per available seat mile year over year expected to be up 2 to 3% versus the flat to down 2%. And then the economic fuel costs here, that's going to come in the range of $2.50 to $2.60 versus the $2.60 to $2.70 previously. So all of these things considered, some of this guidance is also directly related to what they're paying in fuel as of right now, as that's continued to decline as well.
All right, keep it right here on Yahoo Finance. Much more of your market action ahead. We've got the opening bell next. That's the opening bell on Wall Street. You can see the excitement playing out at the Nasdaq. Ooh, a little girl there ringing the opening bell. And we also have the New York Stock Exchange there as we kick off the start to a new trading day. And stocks trying to regain some of that lost momentum yesterday. You're looking at the S&P opening the day to the upside here, looking to regain some of yesterday's losses, a record high there. You've got the Dow also after pulling back from a record high back in the green here today. Much of this morning's sentiment really being driven by the Micron results that we got, the fact that the chip trade seems to be back on, and that is helping boost the Nasdaq here this morning. Taking a look inside at the early sector action as that calibrates. You got technology and materials amongst the leader in early action here today, followed by consumer discretionary. On the flip side, energy by far the biggest laggard, off nearly 2%. You've also got consumer staples, utilities, and healthcare under a bit of pressure there today. And also, I was mentioning the outperformance in the chip makers. Let's pull up some of these semiconductor stocks because you can see green across your screen right now. You got TSM that's also participating in the gains, up nearly 4% here this morning. NVIDIA also moving to the upside here. Broadcom, a lot of this being driven by those Micron results that we got out last night. A huge move to the upside in Micron, the highest level that we've seen in several months. That is really setting the tone for today's trading day. Let's kick it over to Yahoo Finance's Jared Blicker standing by for a closer look inside some of these moves. Jared.
Yes, thank you. Some really interesting stuff here. We have stocks opening at a record high, at least the S&P 500. You were just looking at these semiconductor stocks, and I'm seeing NVIDIA lead the Mag 7 stocks higher, and you can see some really nice gains here. But I do want to take a minute and go over to crude oil because that's what I'm really focusing on this morning. You might have just noticed energy, the worst sector of the day. And here we have crude oil. That's Brent crude, BZ equals F, and CL equals F. That's WTI in the United States. Both down 3%. And here is the news. The Saudis are abandoning their $100 crude oil target. This comes from the FT. Not totally surprised, but I think the announcement itself, the fact that they would be so vocal about this and leak it to the press is a surprise for me. Starting in December, they're going to start increasing their output by 83,000 barrels a day until the following December, that's December of 2025, such that at that time they're going to be increased, they will have increased by 1 million barrels a day. Now, currently, they are only pumping 8.9 million barrels a day. That's been as high as 12 or 13 in the past, so they're really working at depressed levels. And the critical thing for the Saudis is they can either have higher oil prices or market share. And it looks like right now they are going after market share. They've had to deal with a number of cheaters in the OPEC Plus regime, Kazakhstan most recently. So looks like a really big plan, game-changing plans for the Saudis. Now, I also have to take a look at China here. China was surging earlier in the week to begin the week, and take a look at what's happening today. This is just phenomenal. Alibaba up 7.5%, Pinduoduo up 11%, JD.com up 13%. And let's just take a look at what's happened this week. JD.com up 32%. And I'm going to put the 4-day look on all of these, sort by performance, and you can just see a lot of these outsized gains. On the top line, the least performing stock has 23.8% increase this week. Now, I think this is just a technical surge. I think that we're also going to have to see some follow through on the fiscal side in addition to all the monetary stimulus they announced. But I'm going to leave you guys with this. Bitcoin is another market I'm watching. And on this year-to-date chart, I would say Bitcoin is at a critical juncture here. It looks like it wants to break out. If it can, it has a shot at these record highs. And if not, probably going to test that lower end of the channel. Guys.
All right, Jared, excellent setup there. Thanks so much. Appreciate it. Well, semiconductor stocks are surging after Micron reported better than expected sales and earnings in its fiscal first quarter. Micron also raised its next quarter guidance thanks to continued demand for its memory chips, specifically the ones used in AI data centers. To break down what the report means for the wider sector, we've got William Kerwin, who is the Morningstar Technology Equity Analyst here. Great to have you here with us this morning. First, I mean, as you're listening into what this company is saying on the call yesterday and now kind of thinking about your thesis going forward, does what you heard materially change the trajectory here for what Micron can continue to deliver for investors who are sending the stock higher this morning by about 17%?
Well, really, the results were nothing short of impressive, but ultimately it doesn't change a whole lot in terms of our medium-term thesis on the company. So Micron has been benefiting from a cyclical upswing in memory demand over the past year. We expect that to continue through calendar 2025. And so even though the results, the guidance beat our expectations for the next quarter, we expect this growth to decelerate over the course of the next 4 quarters. And we ended up maintaining our fair value estimate at $110 a share.
So then is the stock reaction today, I guess, getting a little ahead of itself? Is there too much optimism then that's being priced in?
Well, we think it's a correction from maybe too much pessimism that was happening over the past couple months. There are some analyst downgrades on the stock, some concerns of oversupply, cratering prices in the market. Really, we think these results ultimately showed that those concerns were unfounded, and we think the fundamentals are really strong.
You know, as you think about where this could overflow or broaden out, because we had heard from Micron that they're going to have to invest more just so they can keep up with some of the demand that they are seeing. What type of investment profile do you think that means in terms of their own capital that they'll have to invest back into the business in order to ramp up supply so that they can continue to either outpace demand or just keep pace with it?
They've been guiding pretty aggressively on the CapEx front. So they're guiding for roughly 35% of sales in terms of their CapEx levels this upcoming year. They expect that to accelerate in the second half of the year. So there's a lot of investment that goes into this. Micron is vertically integrated. They produce and manufacture their own chips, but ultimately we don't see this as a sea change for the company. It's already very capital intensive. And that is really what leads to cyclicality in the memory chip industry in the long run. So as much as we liked the print, we like the next 4 quarters for Micron, we still see long-term cyclicality in the future.
William, what does their pricing power look like? I guess how much stronger is their pricing power? How much more of an edge do you think they have just given that strong demand that they've seen?
Compared to competitors in the market, we don't see a whole lot of pricing power for Micron. We view memory chips as commodities, with Micron, Samsung, SK Hynix all producing to similar standards. But in the short term, in this really strong upcycle, pricing in the entire market is up because demand is exceeding supply. So that's benefiting Micron. We expect that to continue again through 2025. But longer term, what we usually expect to see is a more normalized environment where prices come down every year, but that's offset by demand growth. And so we still expect mid-cycle growth for Micron in the long term.
With this in mind, how much of the spending that we've seen go towards chips are you anticipating will cascade into other areas now that language learning models and inferencing as a service is starting to be more prominent and build out its own tentacles as well within this industry?
Ultimately, yes. We think there are going to be far more beneficiaries than the concentrated group that we tend to talk about here in the chip stocks, but it's going to be a long-term story. And right now, it seems like the biggest beneficiaries, like a Micron, like an NVIDIA, are really taking an outside portion of this investment from AI. But longer term, and we're talking, over a 10-year horizon, yeah, I expect it to broaden.
All right, Micron shares rallying here, up just about 16% shortly after the open. William Kerwin, great to have you, Morningstar's technology equity analyst. Thanks so much. Well, coming up, a slew of Federal Reserve speakers, including Chair Powell himself, is speaking this morning. We're going to break down that commentary next. What it spells out for the path of future cuts. We'll be right back.
Long list of Fed speakers on deck today, but will they offer any clues on the path forward for monetary policy after their jumbo 50 basis point rate cut last week? Here with more is Yahoo Finance's own friend of the Fed, our very own Jennifer Schonberger here with us. Hey, Jennifer.
Good morning. I like that. Friend of the Fed. Yes, there are a slew of Fed speakers on deck today, but we are unlikely to get many new clues on monetary policy today. Fed Chair Jay Powell this morning gave pre-recorded remarks at the 10th annual U.S. Treasury Market Conference, which delves into the health of Treasury markets. Powell said, quote, "These markets need to keep functioning at a high level, and we all have a stake in making sure that they do. I remain wholly dedicated to that goal." The annual conference comes after a Treasury yield plunged in October 2014, only to rebound moments later in an episode later dubbed the flash crash. Elsewhere this morning, Fed Governor Michelle Bowman reiterated that she would have preferred a smaller 25 basis point rate cut at last week's meeting because she feels core inflation is still uncomfortably high and that she worried cutting by 50 basis points would signal the Fed sees economic weakness. She will remain cautious in her approach to adjusting interest rates. Also this morning, we just heard from Fed Governor Adriana Kugler and Boston Fed President Susan Collins on regulating banks in a way to broaden access to banking services for everyone. We'll also hear from Vice Chair of Supervision Michael Barr today, who could offer more insight into the path ahead for the Fed's reformed capital requirements known as Basel III. Other Fed speakers on tap today, Neil Kashkari and Lisa Cook. No shortage, guys. No shortage of Fed speakers.
No shortage. You're going to be a busy reporter here today. Fed correspondent Jen will let you go so you can get to all of that. That is ahead here over the next 24 hours. Jennifer Schonberger, great stuff. Thanks. Our next guest saying that while the economy may be slowing, it's not contracting. Rather, the data signaling a soft landing is still possible. Joining us now for today's strategy session, we want to bring in Michael Aroney. He's State Street Global Advisors Chief Investment Strategist. Michael, let's talk about what Jen was just saying. When we're getting the latest commentary from the Fed, it seems like the Fed's very confident that we can orchestrate a soft landing. It seems like you're thinking along similar lines. So I'm curious then what you're gleaning or what you're taking away from the recent jobs data, and then ultimately maybe why you're confident we're not going to see a further deterioration down the line.
So it's clear that both Chairman Powell and broader Fed officials have high conviction that the soft landing is here. He described it in the post-meeting press conference that the economy is in good shape. The labor market by historic standards still looks pretty good. And although he was reluctant to declare mission accomplished on inflation, that he's gained confidence that it's headed in the right trajectory. All these speakers this week will double down on exactly that. And the markets also are alongside. They also believe it. You can see it reflected in asset prices, valuations, credit spreads, and measures of volatility. So I think, for example, you asked about the labor market. This morning, jobless claims actually ticked down. So we may not be adding as many jobs as we once were, but businesses continue to be reluctant to lay off qualified, skilled workers. So the soft landing remains intact. The Fed believes it, the market believes it, and the data supports it.
And so what does that hold for November here? Should the markets want to see another 50 basis point rate cut? Wouldn't that signal something perhaps more dire in the water?
I was a bit surprised at how aggressive the Fed was last week, and I would be further surprised if they do another 0.5% rate cut in November. But I think what it suggests is that they believe that policy where it's at is perhaps too restrictive, that it's far above their preferred measure of inflation, which sits at around 2.5%. So at 4.75% to 5% on the policy rate, they believe that that's a bit too high, and they're willing to take some risks early on to get closer to where they want to end up, which is probably around 3%. Which is what was suggested in the summary of economic projections. But I absolutely agree that the notion that the Fed wants to move quickly does send some mixed signals, and I was a little surprised at how aggressive they were. One other thing is in November, we'll be past the election, so they'll be able to avoid some of the questions around their political independence if they are able to do this post-election.
You know, Michael, we've heard from a number of strategists here over the last several days just how to play the rate cutting cycle now that it seems to be here. And there's been a lot of optimism surrounding small and mid caps. Do you share that optimism? And I guess what does that upside then potentially look like?
I do share that enthusiasm for small caps in particular. And the other thing I want to kind of emphasize here is that it's clear, as I said, Powell, the Fed, and markets all believe in the soft landing. And soft landings are rare. There's only been 4 of them in the modern era, mid-60s, 84, 94, and now I would argue 2024. And so with that, the last kind of analog that we have to look at was 1995. And when we look at that, coming out of that period, what was interesting from a sector perspective, in the first 6 months after the Fed's first rate cut, healthcare, consumer staples, and financials were leadership, and ultimately technology, materials, and discretionary shares were laggards. So I think in some ways, although history doesn't repeat itself, it often rhymes, the playbook remains the same. And what's been interesting is over the last few months, a massive rotation in market leadership has been unfolding, and I think it'll continue. Small caps, cyclicals, value, and lower rate beneficiaries should all rally into year end.
And so with that in mind, I mean, as we're talking about, and you brought up the Fed trying to make sure that they can look apolitical post-election with the next meeting, for what we're expecting to hear from companies and the tenor that they need to strike, given that they're also navigating a more uncertain economic picture than we were in the beginning of this year, what could be the theme of the next earnings season as we're essentially closing the books? We're in the last week of September here right now in Q3.
So I think there's a couple quick things to think about here. I think the market is positioned for this idea that as we head to 2025, the earnings growth gap between technology and the Mag 7 in particular and everyone else will close. So I think in order for this rally to continue and this rotation to persist, that will need to continue. The other thing is that what's happened is earnings growth expectations in June for S&P 500 companies were about 7.6%. Today, they're about 4.6%. So they've come down considerably. So it's going to be important that we beat those lower expectations. I think we will. And then ultimately, the last and final thing is, what are companies saying about 2025? It's expected that earnings are expected to grow by 15% next year. So it's unusual for the Fed to be cutting rates by what's forecasted to be about another 1% next year at a time when you're growing earnings by double digits. In the last 50 plus years in market history, that's only happened one time, 1984, which was another soft landing period. So I think it's important that earnings growth does continue in 2025, and expectations are high. So what executives have to say about that will be important in this next earnings season.
All right, Michael, got so many notifications popping off. I didn't know if this was morning brief or around the horn, but you got some points, no doubt. Great points there. Michael Roney of State Street, thanks so much for taking the time.
Thank you.
Appreciate it. Time now for our chart of the day. Hurricane Helene is getting stronger as it moves towards Florida's Gulf Coast, and that means the oil and gas industry could be at risk for weather-related production outages. Catalyst co-host Maddie Mills is taking a look at the impact past hurricanes have had on production. Hey, Maddie.
Hey, Brad. Thanks so much. So I want to take a look at a chart that we are going to pull up from the control room to look at the history of the impact of hurricanes on oil production. Just to take a look at this. Thanks, guys. So taking a look here, right, you can see previous hurricanes and the degree to which they have impacted oil production. The previous biggest hurricanes in the area coming in 2008, you can see a dip happening, a significant dip in oil production. That, of course, leads to a decrease in supply, which can impact the price of oil. The previous biggest hurricane in the region also had a significant impact in oil. That was Hurricane Ian that came just a couple of years ago. And we also had Hurricane Ida in 2021 as well. So we are already starting to see some facilities closing down ahead of the hurricane. We have 17 oil and gas platforms, including Chevron, shutting their production facilities in the area. It's expected that this storm could cause up to $20 billion in damage across the Gulf Coast, so certainly a significant impact there. Having said that, as Jared laid out really well earlier, we are in the middle of a deflationary period overall in the macro picture when it comes to commodities, so the impact would have to be very severe in the region for us to see a long-term impact on the price of oil. Yes, it could certainly have a short-term impact because the U.S. is the world's largest producer of crude, but it's not likely to have a large long-term impact, guys.
All right, Maddie, thanks so much for breaking that down for us here. Keep right here on Yahoo Finance. Coming up, we are going to be digging into some of today's top stock movers. That's next on Morning Brief.
Welcome back. We're taking a closer look at Yahoo Finance's trending tickers. We've got 3 names to watch: Accenture, Sonos, and Starbucks. Oh yeah, and we're doing it in 30 seconds each or less. Let's go. First up here, Accenture, the biggest market cap company name that is reporting this week based on my last running of the calculation. But anyway, shares right now, they're up by about 6%. They reported better than expected revenue and revealed a $4 billion share buyback as well. Take a look at shares. They're up here on the day. If you were looking for a generative AI mention on your bingo card, you got one. They said we continue to accelerate our leadership in generative AI. They believe is the most transformative technology of the next decade.
All right, well, let's talk speakers. Maybe a little bit more exciting, but let's see. Sonos shares are actually in the red today, off just about 6%. Morgan Stanley hitting the stock with a double downgrade. The firm believing that the company's application redesign will negatively impact its top and bottom line. So they're not excited about the redesign that was announced, to put it bluntly here. Sonos also facing headwinds from the weak market demand, underperforming the new product launch of Ace, and also limited near-term total addressable market expansion. So all that to say, they see limited upside and therefore downgrading Sonos.
All right, great stuff there. I'm not going to shade your company like you did Accenture, but anyway, here, let's take a look at shares of
you love
Starbucks. Well, I mean, obviously, everybody loves Starbucks, but taking a look at the shares right now, investors loving them just a little bit more. They're climbing higher. Bernstein, they're upgrading the coffee chain to outperform. They must have tried a PSL. They were previously at a market perform. They raised their price target as well. $115 is the new one. $92 was the old one. Analysts behind the call expect an uptick in customer traffic to drive sales growth under new CEO Brian Niccol. They say, their words, "We believe that Brian Niccol is the perfect CEO to guide the resurgence of today's Starbucks."
We'll see whether or not the street's been very, very split on this.
That's some cold brew right there. We'll see.
No, but I think the question is just how quickly that turnaround can take place, right? Yeah. All right. Well, coming up, we're getting a fresh read on the housing market. Pending home sales are out at the top of the 10 a.m. hour. We're going to break that down and much more. That's next on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day, and we've got three catalysts for you that's really driving today's action. Fresh economic data, Vice President Harris's manufacturing investment proposal, and AI demand.
The S&P 500 rising today on the heels of slightly stronger than expected GDP data and that jobs data, painting a broader picture of economic strength. Now we're getting pending home sales. We'll get you those numbers in just a moment.
Plus, Vice President Kamala Harris and former President Donald Trump are hot on the campaign trail, both delivering speeches Wednesday on their economic agendas. Now, Harris's agenda included plans for $100 billion in American manufacturing investment. We're going to break down their plans, how they differ, and what ultimately means for you, the investor.
And Micron still surging after its results showing strong demand for AI products. The tech sector, the highest gainer in the S&P so far today. On the heels of that, we're going to sit down with the CEO of an AI startup, Hugging Face, for an inside look at the industry.
All right, let's kick it off with breaking data that we have out right now. Pending home sales rising for the month, up 0.6% for the month of August. That was a reversal from the month-over-month drop that we saw in the previous month. Former NAR chief economist Lauren June writing that, quote, a slight upward turn reflects a modest improvement in housing affordability, primarily because mortgage rates descended to 6.5% in August, so making it maybe a little bit more affordable here to buy a home. I think the question is, though, as rates do come down, what ultimately that means for prices here in the long term. On a regional basis, you have in Northeast sales actually falling 4.6%. That was the only region in which we did see pending home sales fall on a month-over-month basis. On the flip side, Midwest, South, and West all seeing rises here on a month-over-month basis.
I think that was such a great point that you've been great at bringing into our conversation, Shauna, about the totality of the cost of a home. As we do see mortgage rates falling on the heels of those rate cuts, what will we see with prices? Is it just going to be a seesaw that impacts the overall price to the upside? Having said that, I think a great quote from this, they're talking about how there's been an increase in home purchases, both in inexpensive and expensive regions, which is something we haven't previously seen. We've really seen the lower income consumers struggling when it comes to housing, so interesting to see that uptick here as well. Let's turn now to stocks rising about 30 minutes into our trading day. The Nasdaq leading the day up over 1% on the back of that GDP data, showing the economy is growing at a faster clip than expected. Also, the labor market appearing strong as well amid recent concerns. Jobless claims falling to their lowest level in 4 months. Joining us now for more, we've got Deepak Puri. He is the Chief Investment Officer for Deutsche Bank, Private Bank Americas. And it's great to speak with you here. I just want to get a sense of what you think about today's data and the impact it could have on the degree of rate cuts to come forward. Do you think that this moves the needle at all?
Most likely not, Madison. I think today's data is a welcome relief because one of the things this week that happened earlier was the consumer confidence, which really plummeted for current expectations. So I think today's labor market statistics in particular gives a little bit of a sigh of relief that the labor market conditions are not just falling off the cliff. There is some softening in the labor markets, definitely, and we're going to get more insight into that next week with the non-farm payroll data. But so far, so good. And I think one of the comments I would like to make, what the Fed is trying to do, and hence we saw that 50 basis point rate cut in September, is really to avoid the most, as consumption goes down with, let's say, softening of the labor markets, the Fed is trying to orchestrate a soft landing by making sure that the interest rate sensitive sectors of the economy, be it the housing or the manufacturing, starts to, go up so that before the consumption softens, there's enough momentum in those areas of the economy that can compensate for the softer, consumption pattern that we might be seeing come fourth quarter of this year.
Deepak, that is a very interesting point. And I guess for investors trying to figure out ultimately what this means for policy, or obviously there certainly is a lot of uncertainty, but it sounds like from your points that you were just making that this really then does bolster the case for just going 25 at the next meeting.
Indeed, because when you look at, and we're going to get core PCE tomorrow, I think you're going to see a number of around 2.7% year over year. With the kind of labor market data, with the core PCE where it's at, and the consumer confidence data that we saw earlier, I really don't feel that there's enough for the Fed to go for another 50 basis point rate cut. I think the bar is pretty high for another 50 basis points. We expect 2 25 basis point rate cuts from now till the end of the year. Now, a lot can change if the JOLTS data and the non-farm payroll data comes significantly weaker than what we are expecting right now. The expectation is really 140,000 job gains for the month of September. Let's say that comes below 100,000 and the unemployment rate and the underemployment rate goes up. That might bolster the case for a 50 basis point rate cut. But as things stand as of today, I think 25 basis point is a more of a base case scenario.
From your point of view, though, does the equity market care so much about the debate of the upcoming size of the cuts of 25 or 50, or are they already kind of looking ahead to next quarter's earnings as the next big catalyst?
Yeah, that's a good point. I think obviously we know that the cycle has started, the easing cycle. And it's not just here in the US. I mean, it's a global phenomena. You see a lot more central banks starting to cut rates. We saw Swiss National Bank doing the same. I think the focus is definitely on corporate earnings, some of these secular tailwinds like the AI story. And I think that's where the market's going to be laser focused on. One thing to keep in mind, even though the third quarter earnings, I think, have come down from, let's say, 7.5% bottom-up estimate to around 4%, my concern is really for 2025, which still seems a little bit optimistic at 15% year-over-year EPS growth, given where we are. If you are going to see softness in the labor market, softness in consumptions, maybe 15% EPS growth at this stage of the business cycles look a little bit overambitious.
So then, Deepak, what do you think, I guess, is more realistic than if we're not going to see that degree of growth?
Yeah, I think, our base case is that we see a soft landing, which means that we avoid a recession. B, I think a lot depends on what happens on November 5th, what kind of fiscal policies come on board come 2025. And I think lastly, corporate earnings, obviously, it's a very big determinant of where the price index for us comes to be at a fair market assessment. All that, seems to be at a very nice, soft, sweet spot right now. And I really would like to quote what Fed's, Governor Goolsbee said. Right now, when you look at the macro environment, it's something that you want to freeze in time, because the 6-month core PCE number, month over month, when you analyze that number, is around 2%. Unemployment rate is full, stable employment. So pretty much both sides of the mandate are perfectly in line. Something's got to give. And I think it's most likely is the labor market data that's going to soften and go up, that's going to create some distortions. Having said that, I think overall the secular bull markets remains intact, which means that, that should be a positive. However, you can't really rule out any pullbacks given we live in a very overcharged world with a lot of geopolitical environment, and obviously being an election year that can play a role as well.
All right, Deepak Puri, Deutsche Bank's Private Bank America's CIO. Thanks so much for hopping on and joining us here this morning as we kick off the show. Well, coming up, we've got some updated economic proposals from Vice President Kamala Harris and former President Donald Trump. We're going to dive into what investors need to know about those plans next.
I'm a capitalist. I believe in free and fair markets. I believe an active partnership between government and the private sector is one of the most effective ways to fully unlock economic opportunity.
That was Vice President Kamala Harris laying out her economic agenda in Pittsburgh yesterday with a real focus on manufacturing. The Democratic presidential candidate promising tax credits and investments for American manufacturing. Joining us now, we want to bring in David Wessel. He's the director at the Brookings Institution. David, it's great to have you here. So lots to get into. And we certainly are hearing more and more from Vice President Kamala Harris as we have just over about a month here until Election Day. I'm curious, this pitch that she is making, this pro-business pitch, you think, to voters, just your reaction to it and whether or not you think it is enough to register with those that aren't convinced so much that she is that capitalist that she's saying she is.
I think she's trying to do a couple of things. One is she's trying to prove to the voters that she does actually have an economic plan. We know there was some skepticism early on. They put out this 82-page book, which does have some details on it. Secondly, I think she's trying to counter the notion that President Trump has spread that she's a socialist. She knows she has the progressive wing of the Democratic Party locked up. She needs to move to the center, get centrist voters, and particularly businesses, not to see her as an enemy. And I think that's what she was doing yesterday.
I want to get your take on some of the key differences between Harris and Trump's proposals here, specifically with regards to tariffs. Earlier this week, former President Donald Trump discussed potential tariffs specifically related to one company. Let's take a listen.
John Deere has got to understand that if they build in Mexico, if they start closing plants, in this case it was in Iowa, they're going to close a big plant. And a couple of them. And that's just the beginning. The problem is that's just the beginning. Then all of a sudden you'll hear in a year from now they're going to do another one. All of a sudden they're not going to be in the country anymore. They're going to have to pay a very big price to be able to sell that product into the United States.
So that's one example of Trump's policies and thinking with regards to tariffs. How does that differ from Harris's proposals?
Well, I mean, on the tariffs, there's a clear difference. President Trump believes in tariffs and he says he's going to use them. Sort of ironic that he's going after Deere for doing something that is in a free trade pact with Mexico that President Trump signed that allowed for this kind of movement. So I think that both of them are trying to double down on it. We're for American manufacturing. Manufacturing seems to be in these days, even though fewer than 10% of American workers work in manufacturing. But she wants to do it through more carrots, and he wants to do it through more sticks.
David, when it comes to the manufacturing focus, I'm curious to get your perspective on this. If we could throw up a chart and really showing just the manufacturing jobs as a share of U.S. employment. And I bring that up because, to no surprise, and it's something we've talked about time and time again here at Yahoo Finance, obviously we have seen this steady decline. So I'm curious to get your perspective. Clearly, it is a huge issue in some of the key swing states, which is why this has become such a talking point. But beyond that, why make so much of manufacturing? Is it more of a nostalgic play, do you think, at this point?
I think it is largely a nostalgic play. President Biden, I often had the feeling that he wanted to see how he could recreate the economy that in his mind we had in the good old days of the 1950s. And we know that President Trump has always been hung up on physical investment, whether it's real estate or manufacturing. It is true that manufacturing jobs tend to be good jobs. They're more likely to be union jobs than some others, but most Americans work in non-manufacturing jobs, and people who suffer from globalization are not only manufacturing workers. Think of the call centers that moved offshore. So I think it's become a metaphor for how do we make the middle class better. And as you point out, it is particularly important in these swing states. And of course, that's what's going on here. Both President Trump and Vice President Harris know which states are key to the election. Just look at this proposal to do away with taxes on tips, which is clearly just a play to Nevada voters. Manufacturing, Pennsylvania, Wisconsin, North Carolina, that's why they're doing it.
Harris also spoke about keeping U.S. steel being more important, keeping it domestic being more important than increasing and keeping jobs stateside. How unique of an approach does that feel in comparison with Trump's policies when it comes to the labor market?
I think they're in the same place there. They seem to want to make sure that Nippon Steel doesn't buy U.S. steel. I think it's a bit of xenophobia playing to people in Western Pennsylvania. I mean, one might say that Nippon Steel wants to invest billions of dollars in U.S. steel, and it might be better for the workers there. But we're in a stage where we seem to be frightened by foreign competition, and both of them sort of are sounding that alarm. I think where they're different is in general, President Trump wants to lower taxes, get rid of regulation, let the market do what it wants, use the stick of tariffs to direct things to what he wants. She's not going to use tariffs as much, although, of course, she'll stick with the tariffs on China that Trump imposed and Biden continued. She wants to use the tax credit thing, more carrots to get them to invest in America and invest in American workers.
I also want to switch gears a bit and talk about New York City Mayor Eric Adams indicted after federal corruption investigation here. Obviously, with New York City being really the financial center of the world, I'm curious if you can talk about any potential impact to businesses looking to continue to invest in this city and operate here. Is there any potential outpouring from this investigation that could be a headwind to business in the city?
I wondered how you were going to get the mayor's indictment into economics. That was very artfully done. Look, I think the answer is no. What makes New York function as a financial center has very little to do with the mayor of New York. I think it's an embarrassment. It may have some political implications, although it won't make it any easier for the Democrats because it's kind of distracting. But I think that it's a shame, and and as I said, it's embarrassing. But what happens in New York largely happens in the private sector, not in the halls of the city government.
Yeah, and David, that has been my takeaway too. And I think my question to you is what this means in terms of how problematic it could be for the election. And because you have some prominent Democrats, at least at this point, AOC being one of them, coming out saying that, yes, he should step down. To have this hanging over the Democrats heading into the election, how big of a risk is that, do you think?
It's definitely not a plus. Both parties would like to take New York State. The governor of New York, apparently, from what I read, has some power to try and remove the mayor if he doesn't resign. We have both the minority leader in the Senate, Chuck Schumer, and Chuck Schumer, the lead Democrat in the Senate, and Hakeem Jeffries, the lead Democrat in the House, are both from New York. So the spotlight's going to be on. And it undermines their case that somehow Republicans are corrupt, Donald Trump is corrupt, Jared Kushner is corrupt, Mark Robinson in North Carolina is a bad egg. It makes it harder for them to make the case that Democrats have the moral high ground when you have this really embarrassing situation. Seems like every city government official in New York has had his house searched in the last 2 weeks.
All right, David, we got to leave it there. Thank you so much for joining us, David Wessel over at Brookings. Thanks so much.
You're welcome.
Coming up, we're going to take a look at some trending tickers on the Yahoo Finance website. We'll give you the news behind the moves in CarMax, Costco, and Boeing on the other side.
Time now for some of today's trending tickers. You can scan the QR code below to find the best and worst performing stocks of this session with Yahoo Finance's trending tickers page. Let's lead it off with CarMax. You're looking at shares on the move this morning after beating revenue expectations in their second quarter earnings that were just released. However, an increase in unit sales from the company was offset by a drop in auto financing income, which saw a year-over-year decline of just about 14%. Although not really weighing on shares here in early action, you're looking at gains of just about 6%. Now, this is that used car retailer that we have been covering time and time again, really giving us an inside look at the consumer, some of those consumer spending trends. So again, the fact that we did see this uptick in net income here, 85 cents a share for this quarter, obviously coming in a bit better, a bit of an improvement, I should say, in terms of what we had been expecting. Retail unit sales rising just over 5%, 5.1%. Same-store used sales, they rose 4.3%. Clearly an indication that people are still out there buying. It is important to point out, though, that used vehicle sales, the average of that actually was down 4.6%, which is in line with some of the inflation data that we've been getting out here in recent months.
Yeah, and that's a great look at the kind of consumer side of things. A big sticking point for investors, though, was the loan losses in that side of the business here. The CarMax auto finance side of the business had an income of a little over $115 million. That is a 14.4% decline from a year ago, mostly due to an increase in the provisions for loan losses, really offsetting growth in that side of the business. So certainly something that is going to put pressure on a name like this, and you can see that reflected in the share price as well. Let's turn now to a company reporting after the bell today. Costco shares still on the move this morning to the downside, down just about 0.5% ahead of the company's fourth quarter results. Analysts are expecting another solid quarter from the discount retailer, hiking its annual membership fee earlier this month. I just want to run through a couple of the superlatives that we've gotten from the street ahead of this. Evercore talking about how they've had solid traffic, good market share gain, and cost controls as well. Raymond James also citing their product mix and their sticky customer base as two positive potential pieces of information that could come from this report today.
Yeah, I think any more insight just in terms of the strength of the consumer is something to really glean from this report as you try to extrapolate it and really figure out what exactly this sends about not only just Costco, but the rest of the sector when you take a look at some of the trends that we have seen. So, of course, the focus is going to be on this report. And it seems like you were saying, at least the street relatively positive heading into this, very excited about their loyalty membership, what exactly that could mean here going forward. And you mentioned some of those highlights there. What stuck out to me from Evercore's commentary was they called it a fortress balance sheet, right? And they talk about the fact that their loyalty-driven model is going to help fortify that. And they also went on to the fact that it should enable the company, or that specifically, to trend higher and continue amid a, quote, choppy consumer backdrop. So again, a name like Costco here potentially benefiting at this point in the cycle and not necessarily deviates too much from what we've seen in past quarters. All right, let's end with Boeing. The company has still yet to come to an agreement with their union here, which has been on strike the past 2 weeks, causing production to grind to a halt. Bank of America estimates that Boeing is losing as much as $50 billion a week. Some 30,000 workers continue to strike for better pay and better benefits. For more on the long and short-term impact of the strike and ultimately what this means for the company going forward, we want to bring in Ben Chocanos. He is S&P Global Ratings Aerospace Director. Ben, it's great to have you here. So here we are with the strike continuing. Obviously, this is problematic for Boeing. We cited Bank of America's estimate for the material impact it's had on Boeing or going to have. What's your estimate so far?
Yeah, I think it's probably more like $1 billion a month. It depends a bit on what offsets the company can make in terms of what they can do to reduce costs. We've seen some voluntary furloughs and things like that. But there's no question it's going to be a significant amount of money the longer the strike goes on.
So how much more of this can Boeing really take, Ben?
Well, from a rating standpoint, and that's what I do. The company was under pressure before the strike, and as the longer the strike goes on, the more pressure they're under. We were anticipating the company would use about $10 billion of cash this year. The strike certainly pushes out recovery in the 737 MAX production. Probably into next year. and also delays free cash flow generation, which are keys to maintaining the rating.
For the new CEO, just the ability to navigate this, maybe what this signals about the coming months or the turnaround plan, how much of that do you think, at least in investors' minds, has it been placed in jeopardy at all, at least in the short term?
Well, I mean, certainly the CEO is quite new, and he's got had a pretty big challenge ahead of him before this strike happened. So one would hope that he got a little bit of a fresh start, but it's certainly off to in a difficult place at the moment.
I'm curious, too, when you think about the financial side of things, we have seen spreads on Boeing's outstanding bonds really tightening since the strike started, even though investors have been sellers of those bonds. And I'm inclined to think that that is kind of the macro of what we're seeing with the Federal Reserve's rate cutting cycle. But what does that tell you about the health of Boeing and how investors are viewing this asset?
Yeah, the company has a unique market position as one of the two major aircraft makers. So they have, to some extent, some cushion. I think you pointed out some of the reasons why there could be some tightening. The company has also indicated that they're committed to an investment-grade balance sheet, and has essentially signaled that they would consider an equity raise. And to some extent, I think that's probably a factor as well.
How big of a factor? And that is the factor, right?
Yeah, I think there's no question that's a big driver, and I think the longer the strike goes on, the more expectations solidify around an equity raise.
All right, Ben Sakanos, thank you so much for joining us. Really appreciate it. S&P Global Ratings Aerospace Director. Coming up, we're going to talk all things artificial intelligence, from a sit down with the CEO of Hugging Face to the latest news on OpenAI. We've also got more on those Micron earnings. We've got you covered next right here on Catalysts.
A big rally in chip stocks underway this morning off the back of Micron's strong results, which showed continued demand and very strong demand for its AI products. Taking a look at shares of some of those larger chip makers here this morning. Right now, you've got Micron up just about almost 16% and had moved to the upside of just around 20% earlier today. It was the biggest intraday move that we have seen in Micron stock going all the way back to 2011. You can see the optimism that we did hear from Micron and really what that told us about the surging and unrelenting demand for AI products. That is playing out across this sector. When you take a look at the outperformance of NVIDIA, Intel, AMD, Broadcom, just some of those names within that sector posting gains today, although nowhere near to the degree of the optimism that we're seeing play out in Micron. And we were speaking with a strategist, or an analyst, just last hour, and he was basically saying that, yes, there is a lot to be encouraged about, but he thinks too much negativity was priced into this print. And yes, there is a lot to be optimistic about in the short term. In the long term, he doesn't really think that this really affects the investment narrative surrounding Micron. But again, any sort of good news here when it comes to AI demand and really validating or confirming some of the thought on the street about the outperformance of AI stocks leading up until this point is going to further help some of that recovery that we have seen in chip stocks from ever since they did peak and pull back in July. Let's send it over now to Brad Smith, who's standing by with some more on the AI space. Brad, in the newsroom.
Yes, thanks so much, Shauna. Well, IBM and NASA are partnering to develop an open source AI model for weather and climate analysis, using and including and improving some localized forecasts, predicting severe weather, enhancing global climate solutions, and more. Now, the foundational model trained on NASA's data is now available on Hugging Face. This is the artificial intelligence startup which runs thousands of open source models for developers to test new language learning models. And joining me now is Hugging Face CEO Clem DeLong here in studio with us. And before it was thousands, but now I understand it's millions of public models that are now on Hugging Face. Just talk us through the scaling of this business and partnerships like this that you've got with IBM, with NVIDIA, with Google. I mean, you've really racked up some of the largest names in mega cap tech right now that are leveraging Hugging Face and partnering with you.
Yeah, we're actually crossing today 1 million public models on the platform.
Wow.
There's one new repository that is created every 10 seconds on Hugging Face. And what's interesting is that it's not only text chatbot models like ChatGPT, but a lot of them are in other domains like biology, chemistry, image, video. So this example of a model and a data set released by IBM and NASA is interesting because by forecasting climate events, it's actually AI for good, right? Because the numbers of people who die from our inability to predict weather events is massive. And if you can use AI to reduce that number just by predicting these events maybe a few hours before, this is a massive positive impact that AI has on the world.
Yeah, absolutely, and really speaks to the strength of artificial intelligence as well, and inferencing as well. And that's something that your business is leaning a lot into, inferencing as a service. How does that change the profitability perspective and trajectory for the business as well? Because you've already become profitable at this point.
Yeah, we've always been very intentional about picking the revenue streams and the offering that are very much like kind of like creating value for customers, and as a result can be high margin. That's how we managed to be profitable today, which is quite rare for AI startups, which are usually on the opposite spectrum. Most of them, even the biggest one, are actually burning much more.
Is that OpenAI?
All of them.
Yeah.
You know, like it's incredible that we managed to keep such like uncertainty at such high level of revenue. That's a little bit the nature of the field, but we've taken a little bit of a different direction where we focus more on profitable, sustainable revenue because we build a platform for the community, and so we want to build that for the long term.
You know, I heard this question asked on one of the earnings calls this season, and I think it was Oracle's, and it was about the market transitioning to from an AI training phase and all of the purchasing around chips that have really just run away with so much of the attention to an AI inferencing phase, and what that changing in the model, or at least evolution in the cycle, would mean for companies like yours and getting some of that investment. You know, what does that look like as the revenue model for Hugging Face becomes more solidified as well?
Well, I think that means looking more at AI in production. You know, not only looking at how do you build experiments for AI, but also how do you put these experiments in production for millions of users. So for Hugging Face, one interesting thing is now, I mentioned these 1 million public models on the platform. Something that people don't really know is that we almost have as many private models on the platform that companies are using internally in production for their use cases. So we're seeing this transition from AI for prototypes, for experiments, to AI in production. And in terms of like revenue, I think that means more companies using our enterprise hub offering that has been very, very successful. And in general, kind of like looking at more of the cost for AI, especially when you scale, to make sure you can keep margins that are sustainable.
You know, I'm going to take a step back here, and then we'll go kind of rapid fire with the time that we have left. But just where are we at in the generative AI cycle right now? And how far are we from the point where it feels like my grandmother might even know the difference that artificial intelligence is having on her day-to-day life?
So I think we're quite mainstream on the usage side. We've seen some sort of a catch-up from investors and the public on AI. And maybe we're at the phase where it slowed down a little bit, or at least we have a more realistic view of what AI can do and can't do. It's more mature. And hopefully in the next few years, we'll keep kind of like improving the use cases, expand from just text to all the other domains, as I mentioned. And really make it mainstream.
All right, we got to go. But is this, you know, a period where you think about Hugging Face being a publicly traded company at some point in the future?
Not yet. I think we're happy to be private right now. We're doing some acquisitions. We've done 2 in the past three months. So the idea is to keep building the usage and the revenue in the next few years.
Thank you so much for joining us here in studio, Clem DeLong, who is the founder and CEO of Hugging Face. Thanks so much.
Thanks for having me.
Absolutely. And Maddie, I'll toss things back over to you in the studio.
All right, Brad Smith, thank you for bringing us that interview. Really appreciate it. It is time now for our trending stories, and today it's all about AI and specifically OpenAI. A series of departures announced, including Chief Technology Officer Mira Murati leaving the company. The news came just before reports that OpenAI weighing a shift to a for-profit model that would reportedly give CEO Sam Altman a 7% stake worth up to $10 billion. And all of this kind of linked together here, right? The leadership changes coming in here on the heels of the news that this is switching to a for-profit company while they are also raising a lot of capital. It's all kind of one ecosystem of change.
It is, because it comes at a critical time for OpenAI, and I think a lot of people are out there watching or trying to figure out what exactly is going on inside the walls of OpenAI right now. And it is important to point out that Murati's departure right now, they're still discussing the timeline. It seems to be her last day at OpenAI has not been fixed. This is all according to reports here, but she's still discussing the details of her departure with company leadership. And there was a spokesperson that went on to say that they do remain focused on building AI that benefits everyone. And as we previously shared, they're working on our board to ensure that we're positioned to succeed in our mission. But again, when you talk about the fact that we could really see an adjustment or realignment in terms of the purpose, the long-term purpose of this company, just for-profit versus nonprofit, obviously that's a critical issue for many of the higher-ups in OpenAI, many investors as well. And then also just the fact that this is coming at a time when they're looking to secure new funding, and that new funding, like you said, could reportedly value the company up to $100 billion. A shakeup like this, the timing, that is why the story is getting so much focus here this morning.
That's exactly right. And as they make this shift, Altman has teased out the idea that it could be a public benefit corporation to kind of perhaps appease some of the leadership that has already left. Having said that, I want to pull up something that Sam Altman said on X regarding the amount of leadership changes they've seen. He says, quote, "Leadership changes are a natural part of companies, especially companies growing so quickly that are so demanding. I obviously won't pretend it's natural for this one to be so abrupt, but we are not a normal company." And I think that is really interesting that even Altman himself is noting that this does feel a little bit abnormal, right? Multiple co-founders of this company have already left over the past year, and we are just approaching a year since Altman himself was ousted as well, Shauna.
Yeah, not a normal company. I think you can do a whole segment on that, just ultimately, but what that means, maybe what that signals about future investments and where the company goes from here. But again, lots of questions about the direction of OpenAI here going forward. Well, coming up, our very own Brian Zazi had an in-depth conversation about the consumer retail theft, and more. With Target CEO Brian Cornell, it's part of our series Lead This Way. We've got that for you next. We'll be right back.
If you grow up the way I did, you always feel like the underdog. I see myself as part of the team that's reinvented the company. We talked about go time, becoming grow time. This has got to be Target time.
Target is as recognizable a brand as Coke or Nike. CEO and retail linchpin Brian Cornell, who's been at the helm of the company for more than a decade, is not. The cheap chic retailer has long held its own in the retail landscape, finding its niche as a low-cost but trendy alternative to Costco, Walmart, and even Amazon. That is, until recently. Soon after sales soared over $100 billion for the first time, Target began to miss the post-pandemic mark with shoppers, seeing sales decline for 4 straight quarters through Q1 of 2024.
We've had to be incredibly resilient and recognize that we've got to get ourselves back on track for growth.
Yahoo Finance sat down with the veteran CEO at Target and in his old stomping grounds of Queens, New York, to understand what's driving this retail competitor to get back on top and his plan to win back consumers and investors. Since peaking in 2021, Target stock is down about 40%. Earnings per share were more than cut in half between 2021 and 2022. A combination of other factors, notably a rise in retail theft and a jump in inventory, led to a more than $4 billion dip in profits for Target between 2022 and 2023. In 2023, Target sales took a hit from backlash to its Pride merchandise, part of a broader sales decline, decreasing by 1.7% year over year in 2023. Over the same span, the stocks of Target's competitors Walmart, Amazon, and Costco were in the green, and still are.
Our frequency categories have performed really well, but half of our portfolio is in apparel and home and hard lines. And those categories, not just for Target, but overall, have seen a slowdown.
Following a pandemic-related spending surge, discretionary spending petered out, hitting Target more than rivals, as nearly half of the company's portfolio consists of non-essential items like home goods and clothing. Cornell diversified Target's product offerings, increasing groceries to 23% of sales in 2023. But competitors like Walmart earn nearly 60% of its sales from groceries. More than 50% of Costco sales come from food items. And while Amazon is less reliant on essentials, its business is much more diversified as a whole. This isn't the first time Cornell has faced an uphill battle.
I think fear is a factor. You know what it looks like on the other side, and you don't want to go back there.
Growing up with a challenging home life in Queens, New York, the CEO went on to hold executive positions at retailers, including Safeway, Sam's Club, and food and beverage giant PepsiCo. Cornell became the first outsider to take Target's top job in 2014, at a time the retailer was struggling and coming off a major data breach.
What was that initial call like when you got the job or the offer to join Target?
I did a lot of homework on the company, but I knew Target from my years in consumer packaged goods, working with other retailers. I thought about the opportunity to take this iconic brand, Target, and get it back on the right road, get it back to being a growth company.
Cornell's first order of business, closing down the company's $5.4 billion unsuccessful foray into Canada.
They expected Target to be the Target that they saw in the United States. And we had issues with in-stocks. We had issues with the overall guest experience. It was a difficult discussion with the board, and we thought about it very carefully. But I recognized the right thing for us to do was to exit the market.
So you don't regret that?
No regrets. I would love to have had a chance to be part of the team that entered the market. Because I think had we gone in there with 5 stores that became 10, test, learn, iterate, I know we would have been really successful.
After a few years of stagnant revenue growth, Cornell announced some very large investments. The $550 million acquisition of delivery company Shipt in 2017, and a $7 billion investment in Target stores. A big reason behind Cornell opening more than 250 locations, including small format urban stores, many during a period when all signs were pointing away from brick and mortar retailing.
We talked about our digital strategy starting with our stores. Talked about stores as hubs, that we're going to use our stores as mini fulfillment centers. People's heads were spinning, but that might have been, in the course of my time at Target, the most important day.
Well, did you second guess yourself?
I didn't.
No.
We knew because the consumer had told us we're doing the right thing. Certainly those investments we made going into the pandemic, where drive up and pick up and our same day delivery to your home were so important. But the physical store experience was also important, because when people walked into a store like this, they knew it was safe, it was clean, they wanted to be there.
Inside those stores, Cornell also invested in Target's owned brands, a secret weapon that has set Target apart versus its rivals.
How big is the private brand portfolio for Target?
It's a little over $30 billion now.
It's massive.
Yeah, with 11 brands that are billion-dollar brands, including a few like Good & Gather or Cat & Jack that are multi-billion-dollar brands.
Target's own brands currently make up about a third of its portfolio. Target has also relied on third-party partnerships under Cornell, from product lines to incorporating businesses like Ulta Beauty into stores to outsourcing pharmacy operations to CVS. These decisions collectively drove growth, as the company's revenue increased by nearly 50% from 2015 to 2022. Target's return on invested capital peaked at 22.64% in 2021, but as inflation rose, Target sales declined, a trend noticed by investors.
People are, talking about what we've done, and you're getting the accolades, and then 13 weeks later, you got to be delivering the same kind of results. You're always going to compete. You got to do it again and again.
Cornell's competitive nature was developed at this very playground in Whitestone, Queens, a place he hasn't visited in decades.
Does it look similar to it at all?
It looks exactly the same.
Oh, really?
I grew up without a dad, the support of my mom, lots of support from my grandparents, but certainly it wasn't a classic lifestyle where you say, all right, here's a kid who's going to grow up to be successful, certainly not run a company like Target. But, I learned early on in life the importance of school, and performing well in the classroom. I gravitated towards sports. It was something that was really important to me.
Why did sports mean so much to you?
Nobody really cared how much money you had, what your parents did. What they cared about is, did you show up? Did you put great energy behind it? Could you perform?
Did you feel like an underdog in part because of how you grew up?
I think if you grow up the way I did, you always feel like the underdog. You always worry about, all right, taking that step back. So I think it's always given me a bit of a competitive edge and kind of lean in, make sure that nobody's gonna ever outwork you and you're gonna give it your all and try to perform every day.
It's a mindset that set Cornell up for the world of retail long before he even came to Target.
Of all the different industries you could choose, retail is probably the most competitive one. You either love this or it's not for you.
At 65 years old, the hyper-competitive retail business is still for Cornell, as he looks to cement his legacy at a pivotal time for Target and its investor base. Part of Target's growth strategy now includes taking a page out of its competitors' playbook, a paid membership program called Target Circle 360, which launched in April of 2024.
You can shop our stores, you can use our drive-up, and if you need something delivered to your home, we'll get it to you within a couple of hours.
The $99 a year program's main perks include free 2-day and same-day shipping. It's all part of an effort to improve the customer experience in digital ways and in person, as Target plans to open 300 additional locations over the next decade.
During the pandemic, when most of us were staying home to stay safe, over 70% of all the retail dollars were still spent at a physical store. I know that 10 years from now, you'll still be shopping in a store, and some days you'll click your app and use the drive-up lane. Some days you'll say, just please deliver it to my home.
Cornell is also lowering prices again, not to get rid of inventory, but as a strategy to get more people through Target stores and to keep them there even longer. These strategies may be starting to pay off, with second quarter sales up 2.7% from 1 year ago.
We stayed focused on listening to the consumer, listening to our team, thinking about the right things for Target, and staying really focused on execution. And we brought all that to life in the second quarter. And we've got to build on that momentum.
For now, Cornell's focus remains on getting Target back on track for investors and for customers, a literal target for Cornell as he potentially eyes moving on from the top job.
When you don't wake up energized about the impact that you can have, it's time for you to step aside and start thinking about what's next. Fortunately today, I still love what I do. I'm surrounded by a great team. I wake up every day thinking about how I can impact the organization, but I won't do it forever. And I'll make sure when it's my time to step aside, there's a great team in place that I know is going to guide this company forward and do even better things than I've done in my 11 years.
Our thanks to Brian Cornell, and of course our thanks to Brian Zazi for bringing us that interview. And you can watch the extended cut of this interview with Target CEO Brian Cornell. That's on Yahoo Finance's YouTube page. We want to get to some breaking news crossing the wire. Supermicro, the server maker, is being probed by the Justice Department following a critical report by an activist short-selling firm. This is according to a report from the Wall Street Journal. You can see shares have resumed trading. They were briefly halted following this report. That stock is now off just over 10%. Now, the Wall Street Journal is reporting that this probe is still in its early stage. It appears to be connected to the former employee accusation of accounting violations. Of course, that was one of the things that had been cited in the Hindenburg research filing here, accusing Supermicro of a number of things. That was just about a month ago to the day. I believe it was the end of August that report was released. So again, now we are here just about a month later with the DOJ now reportedly probing the company on some of these same accusations.
And specifically asking questions about that former employee, the whistleblower, filing a lawsuit back in April accusing the company of accounting violations, including shipping and billing customers for incomplete equipment that wasn't ready for sale. So certainly a story we will continue to monitor. But we've got wealth coming up right here next, so stick around for a little bit more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks to grow your money. Hey, on today's show, zeroing in on the housing market, we'll discuss whether now is a good time to refinance your mortgage and break down 3 things that home buyers need to watch for in 2025. And holiday shopping season is just around the corner. We're going to talk about where consumers will be putting their money and how much they may plan to spend. Plus, a quarter of job skills may be replaced by AI. This is according to a report from Indeed. We'll reveal which jobs are most at risk later on in the show. All that and much more, but first, we got to zero in on the labor market here. Wall Street is watching for any signs of further cooling, but we got some data this morning actually defying the expectation. Initial jobless claims for the week ending September 21st hit a 4-month low, according to the Labor Department. Here to discuss what the data means and how Americans are feeling, we've got Yahoo Finance's Catalyst co-host, Madison Mills. Hey, Maddie.
Hey, Brad, thanks so much. So listen, this is good news for people in the labor market, right? Jobless claims. That means those people filing for unemployment hitting a 4-month low. And we also saw a relatively low rate of firing. I think that is a key piece to zero in on because there was some concern about companies increasing the amount of layoffs, firing, even attrition, trying to kind of get people out with things like return to office. We are not seeing that when it comes to the data here. Just to run through some of that, those initial jobless claims declining to 218,000 in the week ending in September 21st, which you can see on your screen. That is 3,000 below the prior week's reading and below consensus as well. Moving on here to continuing claims, that's the number of people who were already collecting jobless benefits. That did increase by 13,000 to 1.8 million. You can see that on your screen here as well. So a little bit of an uptick, but not too much. And the insured unemployment rate remained unchanged at 1.2%. Something else that economists tend to look at when sussing out the health of the economy, they look at the 4-week moving average, because when you get data every single week, it can be a little bit volatile. Things like weather, companies that have employees on strike can lead to some volatility. So the 4-week moving average here, you can see 224,750. Again, that's a decrease of 3,500 jobs from the previous week's revised average. So overall, there is some good news to be found in this broader print here. We did see some movement in the Treasury space following this news, as well as traders are somewhat less confident about significant rate cuts to come. Now, if you are a job seeker, that part could also potentially be bad news for you, because you may want the Fed to be cutting rates faster, because that could lead, CEOs to be less concerned about economic tightness, and therefore they might be saying, hey, okay, let's hire more people come Q1 of 2025. But as of today, today's numbers for this labor market, again, those jobless claims coming in at a 4-month low, that is better than expected news, particularly as we have just wrapped up the end of the Fed's most aggressive rate hiking cycle of the last 4 decades, Brad.
Yeah, absolutely. This has major implications as well, because of even when we were thinking back to the Conference Board data that came out this week here about the prospects for positions and the number of people that are even thinking about what their opportunity is to not only have to leave a job, whether their decision or whether forced to, and then the opportunity to get a job. That factors into the consumer mindset, as you were just breaking down a moment ago. Yeah.
Thank you so much for bringing that up, because that was something that really stood out to me this week in that data. 16.4% of consumers expected more jobs to be available. That's a slight uptick from August, but 18% anticipated fewer jobs. That is up from 17%. So the labor market outlook for consumers was more pessimistic in September, which is a difference from the data that we just got in. So is this a sign that maybe sentiment will kind of match the data over time? We will have to see.
Indeed. Maddie, thanks so much for breaking this down.
Thank you.
Turning now to some of the ways that the Fed's easing cycle is hitting your money. The Fed cut rates by 50 basis points this month, causing a flurry of headlines about what savers should do with things like their high-yield savings accounts or CD investments. So let's talk about it with Lee Baker, certified financial planner and founder of Claris Financial Advisors. Lee, great to have you here. First and foremost, just as we get into this high level, what do rate cuts mean for savers?
Okay, so rate cuts mean 2 things for savers, and all of our viewers, I hope you get this picture. On the one hand, the rate cuts impact what you have in the bank, your high yield savings accounts, for example. You're going to be earning less. But on the flip side, You can also save money as it relates to your debt. And so those rates are going to come down as well on a lot of the debt that's out there in the market, although that's going to take a little bit longer.
Yeah, that's what I was about to ask. At what pace do you see that coming down? How aggressive would the Fed have to be? We had 50 basis points in September. The markets right now are trying to price in probability for what November may look like. And over the course of this week, we've seen that even be a toss-up or a coin toss at this juncture.
Sure. One of the things that I think it's interesting, the conversation you were just having about the jobs market. One of the things that the Fed is keeping an eye on is the jobs market. And right, so do they feel like they need to reduce rates at a faster or bigger clip to do exactly what she said and get employers to feel better about bringing on more staff, buying equipment, things of that nature? You know, my guess at this point is that we will see a series of perhaps smaller 25 basis point type cuts over the next 12 to 15 months easily.
While we have you, I want to get your thoughts on a few scenarios here. And first up, say you currently have a high yield savings account. Mm-hmm. With those interest rates coming down, should you move money out of those accounts then?
Not necessarily. You know, one of the things I think we have to keep in mind is why is the money there in the high yield savings account, right? You know, I'm sitting here in Atlanta, hunkered down, waiting for Hurricane Helene to have its impact here. So when we think about a rainy day fund, if this is money that you got for emergency cases, or if all of a sudden I got to pay somebody to cut up some trees, I need to leave that money in a high yield savings account type environment because I need to get to it quickly. And I don't want it to drop down in its value. Now, on the flip side, if I'm looking at that as having some dry powder, if you will, and looking for an investment opportunity, and if I see that opportunity, sure, maybe now's the time where I maybe take it out of the high yield investments and put it into the markets.
Okay, and so with that in mind, if you don't already have a high yield savings account, it sounds like now might be the time to consider opening one then.
Yeah, you absolutely should open one, right? You know, one of the things that's a little interesting, and I'll reflect back to the chart you showed, going back 2-3 years ago, we were in this zero rate interest environment, right? So the money you had in the bank, we didn't earn anything, or let's call it at least something very negligible. Even though the 5% high yield savings account rates are going away, 4.5 is still pretty doggone good. So if you haven't had the opportunity yet, or perhaps you procrastinated like a lot of us do sometimes, now is still a fantastic time to get some money out of just your bank account, put it into a high yield savings account, because in today's environment, you can still get 4 to 4.5% in some of those places.
Lee, just lastly, while we have you here, certificate of deposit, CDs, they pay a fixed interest rate while your money is held for an agreed upon period of time. So with the Fed looking to cut rates further, is now a good time to lock in a CD?
Yeah, so I would absolutely say that now is a good time to lock in before rates on CDs fall any further. When the Fed cuts rates, you see the most activity on the shorter end of the spectrum, if you will, in terms of time period. So if you can go to different sources, do some research, and perhaps find some of those places that are still giving you perhaps 4.8, 5% interest rates on a 12-month or longer CD, go ahead and grab that now before it gets any further as far as rate cuts are concerned. Another thing to keep in mind is to kind of perhaps create a ladder of sorts so that over time you can get rates locked in at different periods. So perhaps 3 months, 6 months, 12 months, and so on.
All right, Lee, you mentioned you were hunkered down waiting for Helene, hoping for the best for you as well as your loved ones as you're navigating through that weather system. We'll hope to check back in the future here for more conversations. Lee Baker, who's the founder of Claris Financial Advisors. Thanks so much.
Yeah, thanks for having me.
Certainly. Let's turn now to the markets and your investment portfolio. The S&P 500 hitting another intraday record high today after a couple data points signal that the economy is still on solid footing. But our next guest thinks that investors might want to prepare for a little bit of volatility ahead. To discuss, we've got Thomas Hayes, who is the Great Hill Capital LLC chairman and managing member here. Great to have you here in studio with us, Tom.
Great to be with you.
So let's discuss this. I mean, what type of volatility profile should people still be kind of keeping their portfolios ready for to weather as well?
Yeah, Brad, I think we had a regime change got locked in last week with the front-loaded 50 basis point cut. And what that implies is that the heaviest weights of the S&P 500, the Magnificent Seven, I think they're going to be a little bit choppy moving here. I think moving forward, history suggests that the unmagnificent 493 will outperform the Magnificent 7. That's because their earnings growth is accelerating while the Magnificent 7 is decelerating. History also suggests after the first rate cut, small caps will outperform large caps by over 11% in the first 12 months. So that's a big deal. Value outperforms growth in the first 6 months after the first cut. And as you probably noticed, everyone has been crowding into defensives ahead of the Fed cut. So I think you're going to see consumer discretionary start to outperform staples. Everyone's crowded into staples and utilities. I think that trade is up. And finally, this is the topic du jour today. Emerging markets will start to outperform developed markets after 10 years of not happening. The Chinese government overnight launched the bazooka. Everyone said, oh, the monetary cuts are pretty good, but we need fiscal. Well, they're issuing $286 billion of bonds. They're giving out money. Things are happening, and the green light is on. That's going to help not only emerging markets, it's going to help multinationals like Nike, that's been down, Lululemon, that's been down, Starbucks, that's been down on China fears.
Yeah, a huge stimulus effort that they're putting forward here and having more international impact here. You know, it's been interesting to get some perspectives on what quality looks like, what the characteristics of quality investment and people who are trying to put quality into their portfolio, what that looks like. What are some of those characteristics from your perspective as well, even as you think about the defensive plays that people can make or how you can make sure that your portfolio is able to weather any type of volatility right now?
Yeah, so you started with the kind of concerns about a little bit of choppiness into October. What made me a little bit on alert is the fact that skew, which is the cost or the implied volatility, the cost to insure 1 to 2 standard deviation corrections, think about 10% plus corrections, has actually skyrocketed to a decade high. That doesn't guarantee that you're going to have a correction right away. It just says it's time to be on alert because the smart money is taking out a lot of insurance. That differs from the VIX, which measures the cost of the at-the-money premium or insurance. So I think if you're on margin, you want to be off margin. We're fully invested. We're going to stay fully invested, ride out any bumps in October after the election clears, provided it's a gridlock outcome, regardless of who becomes president. I think we get a year-end rally. So you don't want to be stopping and starting. I just think it's time to be a little alert, particularly if you're a passive investor and you're overweight the Magnificent Seven, even if you don't know it.
For, it seems like months now, investors have had to hear about the broadening. When the Magnificent Seven and the successes seen in the Magnificent Seven, it would broaden out to other earnings growth or earnings growth of the other 493 companies as well. Are we starting to see that? And if so, is it sustainable as we get into the back half of this year and earnings growth, regardless of the macroeconomic backdrop, comes into focus?
We are seeing it because you're seeing the equal weight index outperform the cap weighted of late. And this was an inflection quarter where the unmagnificent 493, as you referenced, broadening, just inflected and started to accelerate earnings growth. They had negative earnings growth in the second quarter. So not only is it beginning, it's going to accelerate. Small cap earnings growth, 7% this year, 37% next year. So the game is on. It's exciting. It's a stock picker's market. And I'll tell you, the voodoo of China, there's some high quality companies. And to your point, how do you define quality? Is price is what you pay, value what you get. So we want to see a meaningful return on invested capital. That means the debt and equity that the company's taken in. What kind of return are they getting when they invest? We like double digits, low double digits, mid double digits. So there are companies over there. And we like to buy things that are out of favor. As you know, we've talked for many years. In the US, our best tech companies are trading at 23, 25 times. In China, their best companies are trading at 8 or 10 times, and they've got a ton of cash on their balance sheet. And with this stimulus, their economy is going to reaccelerate, and there's going to be huge opportunities, not just for US multinationals that are trading down because of China, but for actually some of the highest quality companies in China that have been left for dead.
It's really interesting. Tom, always a pleasure to grab some of your insights. Thanks so much for joining us in the studio here.
Thanks for having me, Brad.
Absolutely. Tom Hayes, Great Hill Capital, chairman and managing member. All right, guys, coming up, we're just getting started here on wealth. Is the housing market getting stale? I'm tackling the latest data on home sales and affordability next on Wealth. Pending home sales reversing July's slump, rising 0.6% month over month in August. So what does the latest data actually tell us about the health of the housing market? Our very own Claire Boston joins me now in studio on this very data point and matter here. So what does this tell us?
Right, so we are looking at pending home sales from August, and I will say that they are up 0.6% off of a very, very low base, actually a record low. So, it's a little bit of green shoots, but that being said, a lot of buyers are still waiting on the sidelines. We think they are waiting for better affordability. And mortgage rates have dropped a bit since August. So, it does signal that perhaps we'll see a little bit more robust home buying as we head into September and October.
And so with mortgage rates on a downward trajectory here, how is that impacting housing affordability?
We are seeing better housing affordability. Redfin reported today that they had the first drop in how much you need to have to buy the average home.
Okay, that's
since 2020. That is good. Now a family needs to make about $115,000 to afford the median home, but the issue is that the average family in America makes about $84,000. So we still have this really big affordability gap in this country, and that's probably not going to change unless mortgage rates fall a lot further from here.
Do you think that also changes if we see more homes sitting in listings for longer periods of time as well. That was also another Redfin data point this week.
Right. There's a lot of stale inventory on the market. Sometimes sellers only want to cut prices so low. So we have a little bit of a mismatch between what buyers and sellers are looking for here. And, we'll see how that plays out in the fall. Do they want to go lower or do they just want to pull it? It's a little bit unclear.
Yeah, some of those listings in Florida actually made it into my social media feed this week and on that very matter as well here. Claire, thanks so much for taking the time here with us today. Claire Boston of Yahoo Finance. And everyone, the Federal Reserve's bold rate cut last week brought relief to many potential home buyers. But even with mortgage rates slowly starting to ease, most buyers are still staying on the sidelines over concerns about affordability. Can future rate cuts, though, transform this stale housing market into a stable one? Here to share her insights, we've got Kamini Lane, who is the Coldwell Banker CEO. Great to hear you. Great to have you here with us. First and foremost, just in what you're seeing in the data yourself and the engagements that Coldwell is having with some of its potential clients, how are you seeing people go about the thought process of purchasing a home right now, especially with some of the mortgage rate slippage and continuing rate cuts that are anticipated?
Yeah, absolutely. Well, I think that the rate cut was really well received, right? I think it had been kind of on the horizon for a little while, highly anticipated, and it was a great thing to see because as we've been discussing, we really are in a bit of an affordability crisis in the U.S. today, with housing affordability at the lowest rate since 1985, and so I think that the rate cut did get people off the sidelines, and a lot of it is psychological, right? People have been waiting to see some movement by the Fed, and they saw that movement. And I think that is going to spur an increase in affordability, which should loosen supply, right? Because we've seen that lock-in effect with people who had historically low long-term mortgage rates and were unwilling to give that up. So it should ease that lock-in effect, get more inventory on the market, and that in turn will get more buyers on the market.
Kamini, when we think about the real rates that mortgages would need to come down to ignite a totally new wave of buyers to come in, what is your projection there? What would we need to see rates come down to even have first-time home buyers or home buyers that have been sidelined for years really say, okay, now I think I can make sure that I'm able to take out a mortgage and then give myself good terms for a longer period of time?
Well, rates right now are around the low 6%, right? And while that is a lot higher, let's be honest, it's a lot higher than it was post-pandemic, those 2 and 3 and 4% rates that people got used to very quickly. The reality is the low 6% is very much in line with US historical averages. Now, I think what we need to see is another cut, right? And we need to see more inventory on the market. We need to see price increases stabilize. I think the combination of all of those factors is what's going to get buyers off the sidelines. It's what's going to address the inventory constraints. It's going to address the affordability concerns, and it's going to get the market moving. All of that said, we still are in a robust housing market. Well-priced inventory is absolutely moving. And in many of our metros across the United States, our days on market are just a couple of weeks. And we look at a balanced market as closer to sort of 50-ish days on market. Most of our metros are nowhere near that.
Is now a good time to refinance your mortgage if you've taken one out over the past few years or even if more broadly, you just are looking at the market and saying, hey, these seem like more favorable terms?
Well, that really depends on the terms of your mortgage, right? Rates have come down, but again, they really aren't close to the rates that we saw post-pandemic. We have a record number of people who have fixed 30-year mortgage rates that are in those 3%. Now, if you have a mortgage and today's current rates and current terms are better than the mortgage that you have today, then absolutely, it's a great time to refinance. And, the reality is on a $400,000 loan, just 1 percentage point decrease in your rate is about $250 a month, and that is significant.
That is. So what are the 3 things that homebuyers need to watch out for in the rest of 2024 and in 2025 as well?
Yeah, number one is rates, right? We've been talking about it here. I think people are going to be laser focused on the Fed activity, what comes next in November. So I think rates are a really important thing to keep an eye on. The second thing is inventory. We did see, and we are seeing coming out of September, an increase in inventory. And that's something we really like to see, right? Because we have had historically low inventory in the US housing market, which, as I said, has exacerbated a lot of those affordability concerns. So I think keeping an eye on inventory, more inventory equals more choice and more affordability. And then the last thing I think is the potential for buyers having more power at that negotiating table. If we start to see days on market increase and we start to see potentially the market shift towards a buyer's market, because it has been a seller's market very much so for the last couple of years, then buyers will have more potential and more power at that negotiating table. It remains to be seen, but I think it's an interesting prospect to keep an eye on.
Kamini Lane, who is the Caldwell Banker CEO. Great to have you here on the program with us, and thanks for taking the time.
Great to be here. Thank you so much.
Certainly. Well, Hurricane Helene strengthening and barreling towards the Gulf Coast. If you're in the path of the storm, you might be taking a closer look at protecting your home from damage via homeowners insurance. As your biggest investments, you need to know what your insurance covers and what it doesn't, and we want to help you out with that. First, a standard policy covers the actual structure of your home and detached structures like a garage or guest house. That's called a dwelling. Also, personal belongings inside your dwelling here. It covers liabilities just in case someone sues you for an injury on your property. And any additional living expenses here in case you can't live in your house. But insurance only covers you if one of these 16 things causes the damage. The 16 include things like fire, vandalism, smoke, and even a volcanic eruption. And home insurance usually has 3 different types of general coverage. You've got actual cash value, replacement costs, and guaranteed replacement costs. And the actual cash value means that they will pay to replace or repair the home and its contents minus a deduction for depreciation. Replacement costs means they will pay for a replacement or repair without a deduction. And then guaranteed or extended replacement cost means that the policy will pay whatever it costs to repair or rebuild your home. But insurance doesn't cover everything. If you're hit with one of these, like a flood or a sewer backup or a war, you're responsible. But ultimately, you need to read your insurance policy and understand what is covered by your policy and what is not. On the other side of this short break, coming up, holiday shopping season is on the horizon. We'll break down all of the expected consumer shopping trends when we come back.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
It's fall, which usually means it's time for pumpkin spice everything, but the flavor may not be hitting the same for the U.S. consumer and their wallets this year. Our very own Brooke DePalma joins me from the touch screen with the latest on the pumpkin spice economy. Brooke, what's going on?
Good morning, Brad. Happy fall to all of you out there. For pumpkin spice latte lovers in particular, it's been fall for, well, over a month now, with the seasonal drink returning in late August at Starbucks. But it doesn't look like the company received the same type of love it did in years past on debut day. According to a Placer.aa chart, foot traffic for the day of the seasonal menu launch was actually down 0.3% compared to last year. So, how did Starbucks get here? Well, Starbucks is in the midst of a grande-sized comeback. That's according to Bernstein analyst Danilo Gargiulo. He upgraded shares of Starbucks from perform to outperform before market open. Now, that did send Starbucks shares higher today as new CEO Brian Niccol, who joined just 2 weeks ago from Chipotle, is in the early innings of a turnaround strategy. 3 top issues Brian Niccol needs to address, according to Gargiulo, include consumers' perception around value for money. So that's what they're getting for the amount of money that they're paying at Starbucks. And then secondly, the wait time, especially in the morning, and the loyalty program. And now taking a closer look at value. Well, since 2018, Starbucks ticket growth, the amount of money that consumers pay, actually outpaced the industry. And that's leading to what the analyst said is potentially eroding its value perception. We've been talking a lot about the value perception of Starbucks currently has. And taking a look at Starbucks reward program, well, it's trailing behind when compared to CEO Brian Niccol's former company, Chipotle. Starbucks just isn't holding on and gaining its active reward members, something that Starbucks established years ago and something that investors are hoping Brian Niccol is able to reignite as CEO at Starbucks.
And Brooke, while we have you, for those consumers who are pinching their pennies, tell us about the deals coming in the next few weeks. I've already seen a few of them start to cross the wires.
Brad, it looks like the holiday season is already here, returning maybe earlier than ever. And experts have told Yahoo Finance that shoppers can expect even more promotions than last year coming up this holiday season. And we're already seeing that this is a slew of just a few of the companies that are kicking off. Retailers like Target, Walmart, Amazon are unveiling deals in early October. So as early as next week, Target is banking on holiday must-haves like toys and everyday household goods. Walmart offering deals on electronics, home decor, clothes, toys, and Amazon doubling down on electronics, home goods, as well as beauty items. And now keep in mind, all this is by these multiple retailers as well as others to really get consumers in the door ahead of what will already be a shorter holiday season with only 27 days between Thanksgiving and Christmas. So they want to get those shoppers in now, Brad.
All right. Thanks to our own Brooke DePalma. We'll be watching and tracking how the spending takes place and plays out going into the holiday season. Appreciate it. Well, changing leaves and the smell of pumpkin spice in the air can only mean one thing: holiday shopping season right around the corner. So, what shopping trends are we expecting to see this fall and winter? Here with a preview, we've got Michelle Meyer, who is the MasterCard Economics Institute Chief Economist. Michelle, always a pleasure to grab some time with you and gather some insights here. So, what is the anticipation? What categories are going to see some strength this year?
So when we look at overall spending, as we're measuring as retail sales ex autos using our spending pulse data, we're expecting 3.2% year-over-year growth during the holiday period, which for this estimate, we're defining as November 1st to December 24th. But as you all just mentioned, it starts earlier. It's starting in a week, if not already underway. So of course, you want to look at trends and momentum in October as well, which we'll be tracking very closely. In terms of the categories, Brad, I mean, to us, we think we're going to see potentially some improvement or pickup or acceleration maybe in spending on gadgets, on electronics. We're looking for just over 6.5% growth on a year-over-year basis in electronic spending. And that's a function of a few factors. One, the replacement cycle probably is kicking in, especially for some of those things you purchased right after the pandemic. Prices have declined. There's a lot of deflation in those categories. And now interest rates declining. All of that should lend itself to some support for some of those goods categories that have not been in favor of late.
We've also heard that this is going to be a very promotional holiday season as well for companies. What does that mean and they're going to have to do in order to make sure that they are really catching the mind share and the wallet share, purse share of the consumer?
Very much so. And that is consistent with what we're seeing in the overall macro data around inflation. So in our research note that we published along with the holiday forecasts, we created a proxy of the categories in the CPI basket that tend to fall into holiday spending. And a lot of those categories are deflationary. Prices are declining on a year-over-year basis. And that is very much consistent with the fact that consumers are looking for those deals, looking for those promotions, demand-led declines in prices, but also the market. The market is calling for that. There's a lot of competition. There's a lot of new innovation, a lot of new items out of there that can help attract customers and spending. So promotions matter in order to make sure you get that market share.
We got the insight from Conference Board really kind of describing the state of the consumer this week and some of the confidence among the consumer as well. I wonder, in the terms of the health of the consumer, what your diagnosis is over at MasterCard.
So we're looking at the drivers of consumer spending. And when you do, you look at labor market, you look at household balance sheets. And in our view, we're setting up for what should be a pretty reasonable season here for the consumer. The labor market is still solid in my view, right? It has cooled, of course, from the last few months. But when you look at average job creation, it's well in excess of what would be considered an underlying growth rate. When you look at wage growth, it's running above the underlying rate of inflation for goods and services, that core PCE or core CPI deflator. So yes, the economy is shifting. Yes, there's some more vulnerabilities, but it's still an economy that is supporting the consumer. And by the way, has been for some time. One of the data points out this morning, the GDP revisions, I thought they were really meaningful. They showed upward revisions in GDP growth, upward revisions in consumer spending, and upward revisions in the savings rate. So the savings rate is higher than we had previously thought before the revisions.
Michelle, just lastly, while we have you here, I'm taking a look at a data point that came out from Adobe this week, forecasting a record $240.8 billion in the U.S. holiday season online spending. Black Friday is expected to grow and outpace Cyber Monday as well, or the growth there should outpace Cyber Monday is what they're saying. When you think about that figure alone and the digital spending that we're anticipating, I mean, what are some of the core drivers? Is it just me succumbing to all of the different ads that are showing up in my stories or via influencers that are out there and just saying, ooh, that looks nice, I guess I'll just hit buy now?
Well, I think that it is a bit of that. We've made it really easy to shop online. You no longer have to sit down at your computer and make an organized attempt to purchase. You can buy easily clicking on the way as you're walking from one activity to the other, which I tend to do a lot as a working mom. You got to be fast and efficient. So I do think that things have been made easier. Consumers have power in terms of where, when, and how they spend. And we similarly look for strong e-commerce spending. So we're looking for just over 7% growth on a year-over-year basis when we're looking at e-commerce retail ex auto. So we're in line with that view. And that's been the trend that we've seen for the last several years, is this shift towards e-commerce.
You know, I'd be remiss not to bring up the other side of this as well here, Michelle. The New York Fed, of course, continuing to track some of the record levels of credit card debt. How do we consumers make it out of this holiday season and not be in much more dire straits come the beginning of 2025?
It's important to track. It's important to look at all aspects of the balance sheet, debt levels, wealth levels, and debt service ratios as well. So I think you have to look at the complete picture. Debt levels are higher, but so are wealth levels. And you look at debt service ratios, they haven't increased all that much. They're trending close to where they were prior to the pandemic. And with interest rates coming down and the Fed committing to a cycle of lower interest rates, all of that should help. But as economists, we're looking at the aggregate picture. We're looking at the full picture, which suggests we should see continued momentum for spending. But of course, it's going to differ for each individual household out there.
Michelle Meyer, MasterCard Economics Institute's chief economist. Michelle, thank you once again for joining us here on the program. Great to catch up.
Absolutely. My pleasure.
Coming up, a quarter of job skills could be replaced by AI. We'll take a look at how it could change the way that you work and the industries that are the safest. Much more on wealth after the break. You're watching Yahoo Finance. Artificial intelligence could be changing the way that you do your job. A new AI at Work report from Indeed Hiring Lab, it shows that 28% of skills analyzed could potentially be replaced by AI, but 68% are unlikely to be replaced. So even though a quarter of the skills have the potential to be automated, Indeed says AI is more likely to reinforce human workers rather than replace them and us, all of us. Joining me now, we've got Indeed Hiring Lab economist Corey Staley. Corey, great to have you here on the program. Okay, so some good news towards the end of that. You know, even though it could help potentially with productivity, all-out replacements, hopefully less likely. So where are the roles, where are the functions that you're seeing as in the safe bucket, if you will?
Yeah, so as we look at kind of the skills that are safe, you know, with this research, we wanted to really understand what skills it was that Gen AI in particular could target. And what we found in kind of breaking it out is we looked at kind of Gen AI's ability to do theoretical work, problem-solving work, and physical work. And that last bucket, you know, any job that requires physical, hands-on human element is going to be more or less, a little more in that bucket of somewhat safer from Gen AI. But at the same time, it's still unclear what that necessarily means, right? Having Gen AI be able to have an impact on a skill could also be a productivity enhancing thing for many workers as well.
This is really interesting. 28.5%, about 29% of the skills analyzed could potentially be replaced by generative AI. Which skills do you think those are that are ultimately at most risk or most vulnerable?
what we've seen, a lot of the ones that are kind of in that more vulnerable, or the things that Gen AI is doing well right now, are more of the things that require kind of structured data, structured, kind of clearly defined problems, right? So what we found in this analysis was that Gen AI is pretty good when it has kind of a solved problem that it's trying to work through, right? So one of the occupations that we saw that was most impacted was accountants, because there's a large percentage of skills for accountants that involves filling out structured forms and things that are out there. And so Gen AI is able to do that. But I think the important thing here is there are also a lot of skills for accountants and for other occupations as well, which are not kind of that structured type of thing. And there are problem solving skills, uniquely human skills that Gen AI is not able to do. And I think most notably what we found in this research is that there were no skills, as in 0 skills, that Gen AI was able to do excellently well. So really at the end of the day, very unlikely that a lot of these skills are going to be going to Gen AI anytime soon.
So with all of this in mind, I mean, we've discussed at length here for, it seems like a year, the need to acquire skills that are able to kind of co-work or co-pilot along with artificial intelligence. How can one go about acquiring those skills and still being a valuable or added value for so many companies out there that are still looking to have that human touch, but perhaps know how to work with some of the either new co-pilots or some of the new technology as a whole?
Yeah, I love that term co-pilot, right? Like as we start talking about these Gen AI tools, like we need to really be thinking about them, as just another tool in our tool belt, right? Something that as job seekers, as workers, that we can add that to kind of our arsenal to solve these different problems. So as to the way you go about doing that, it's going to depend from industry to industry. But I think the commonality here is that just getting in, learning about these types of tools, playing with them, seeing what they're capable of, and also building your network, seeing what other people in your industry are doing with these tools, are really good ways for job seekers to really start to gain better understanding of what's possible with these tools, and to really stay on top of these technologies going forward.
Corey, while we have you here, AI has been brought up within several negotiation processes, especially by unions and labor workers who have representation, who are trying to negotiate for better contracts, and whatever those contracts entail. It seems like AI comes up as one of the points of contention repeatedly here. But I think more broadly out to who else this could impact. This could impact interns or even entry-level workers. Some of the tasks that were looked at as just passing down to someone who was looking to just get early experience. How can this impact the future workforce as well, as they're just looking to get experience wherever they can find it and just looking to get a foot in the door prior to applying to positions that say, hey, you got to have 7 years of experience for a job that it seems like you could probably just do out of college?
Yeah, that's obviously a big thing that we're always thinking about with this research, and as we think about these skills with what Gen AI is going to do. And it's not surprising, right, that we see job seekers, interns, students who are really questioning what they're going to do, because I feel like a lot of the coverage around Gen AI and these tools have been stories about a robot's coming to take your job. Gen AI is going to take your job. It's going to take these things away. But again, I think I lean more towards the side in this story that, whenever we've seen economically in the past, these types of technologies come into place, they've tended to enhance human productivity. And even if some jobs kind of end up being displaced, we've seen that more jobs end up being created. So I think for interns, for those just entering, I think having an awareness of, kind of what has happened in the past with these technologies as being a potential indicator for the future. In other words, as we have more and more of these tools and they become more common, there's going to be new roles created, new jobs created that interns can start to look for. So maybe that internship will look a little different than it has, but there are going to be new opportunities arise from these technologies.
All right, move over typing class. Hello, AI class. Corey Staley, who is the Indeed Hiring Lab economist. Thank you so much for taking the time here with us today.
Thank you for having me.
Certainly. Coming up, everyone, we've got some tips on how to pass down all of the wealth knowledge that you're collecting here to your kids and your loved ones on the other side of the break. According to research from Bank of America, 90% of parents think that family members are responsible for teaching kids how to manage money. But more than half of college students say they don't feel financially prepared for the real world. So, how do you teach your kids about financial responsibility here? Joining me now, we've got Mary Hines Drosch, who is the head of consumer products over at Bank of America. Great to have you back on Yahoo Finance with us. So, where does the conversation start and how early does it start as well? Because you say kids, we could be talking about a very wide age range.
Absolutely. Well, one of the keys to success in teaching your children to be responsible is starting early. As young as 6 years old. And when you look at children, they don't really understand the concept of money. So helping them just be aware that things cost money and some fun ways to do it, or even when you're at the grocery store with your little ones, helping them understand you're making a choice between this cereal, which is $7, or this one that is $5, so that they're just more conscious about it.
Yeah, no, my parents made me very conscious about that when I was asking them about Lego sets that I could buy and not buy.
Oh, those are very expensive.
Yeah, they've gotten up there. We can come back to that, but as of the research findings here for Bank of America, what really stuck out to you here? Because we're talking about, and we just rattled off the stat, 90% of parents thinking the family is really responsible for this task of making sure that each other is educated financially.
So think about that. 90% feel that they're responsible, yet 50% of college-age students say they do not feel prepared for the real world. So you've got to do things with your children to educate them on it, as well as to give them the experience with money. And that's where allowances can play a big role, so that they have to decide what are their real important wants versus needs. And also the idea of you don't need to spend it all at once. If you want something big, you might have to save. So all of those really help prepare the child to understand how money works.
When do you find that parents are putting some of the financial responsibilities, such as owning a credit card or having, a cell phone even, making those decisions, putting those in their hands and saying, all right, let's see how you develop some experience around this? Yeah,
well, the Bank of America research that we mentioned at the beginning also showed that most parents are getting their kids cell phones at age 11, checking and debit cards as early as 10.
Wow.
And so they're starting to experience money. And that's why we've developed a Safe Balance for Family Banking, which gives the ability for a parent in a very safe and controlled way to give their child access to an account and a debit card so they can learn how to use that money while the parent can control. Make sure that they put limits on how much they can spend or take out per day, can restrict certain categories. So the child's getting the experience while the parent can maintain control so they don't act irresponsibly.
We were talking about this before the segment, but inserting financial education, financial literacy in the education system too, are we seeing strides made here, and where do we need to make a lot more significant efforts so that it shows up for financial preparedness for college students who are coming out and getting life started?
Yeah, there's so much variability in it. Some schools do it much better. Some schools just have greater investment for financial education. And that's why we try at Bank of America to provide resources to all of our segments, especially parents and children, to learn about financial responsibility so they're on the path to financial help. So we have a site, bettermoneyhabits.com, which has just a vast array of financial education. And so even if parents can't get it within the school system, there are other resources out there to help them educate their children.
Mary Hines Drosch, who is the Bank of America head of consumer products. Great to see you again. Thanks for coming back.
Thanks for having me.
Absolutely. Everyone, that's it for Wealth. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. You do not want to miss it. They'll count you down to and through the closing bell.